We live in very interesting times, and when I was asked to teach a course here in Zurich, I decided to do something which is even more unusual than what I usually do. I entitled this course Investing in the Age of AI because I want to follow a certain narrative that I believe is going to have an impact on your professional careers. I'm making some assumptions about you. Now the assumptions will be dispelled. I want to actually go through the room to have you tell us about your goals, your ambitions, but I'll tell you what my assumptions were. My assumptions is that many of you would be conducting or building a career in Switzerland, in the financial sector, in the type of financial sector will develop over the years, which is going to be very different from the financial sector that happened over the 20th century. And this course is going to be a reflection of that. The AI aspect of that is what I think is going to be the main engine of change for the financial sector. I'm not going to talk a lot about banking, a little bit, not a lot about insurance, a little bit, but I'm going to focus more on investing, because that's one of the areas in which I have been doing a lot of my professional career. I want to start me telling you about me, and then I want you to tell me about you. I'll go first. My name is Luis Seco. I come from Canada. I was born in Spain many years ago, but I lived in Canada, North America, for 40 some years. I'm a professor at the University of Toronto, but I was very fortunate that I created a startup company in 1999 that was an investment company. This company, we've been doing investments for several years. I created the company. I did it because it was a spin-off of research I did in the university. So it was a university spin-off, but we ended up managing a portfolio of about $1 billion Canadian for about 20 years. And that made me a very lucky person, because I got to be an academic, supervising students, PhDs, writing papers, and at the same time managing money and getting to learn how both sides of that line look like. And now I use all of that to bring that knowledge to you. And that's how this course has been built. I'm a mathematician by training. Most of my papers have been in different areas of finance. But what I do now is different. I'm now moving into sustainability, or if you want, finance for development, which is the way I think of sustainability. That's what I think money will do in the future. Okay, so having said that, now it's your turn. I know it's many of you. If you can spend a few seconds telling me your name, your background. I do have one objective when I teach a class, which is I would love to learn your names. Very hard, but that's what I would like. It is your responsibility that I learn your name, okay? If you want it, I will be a great collaborator to learn your name. If you don't care, that's okay. But that is one of my objectives when I teach. I teach hundreds of students every year. I like to teach, and I take great pride that on many occasions I do learn the students' names. And there's a good reason for that, which is very likely we will meet again in the future. And when that happens, I want to remember who you are. Wonderful. 2 comments. As I suspected, most of you come from the AI side of things because that's very fashionable and it's actually the right choice. You're doing the right thing. Congratulations on that. That has an impact, which is in my course, I'm deliberately going to spend most of my time on the investment side of things. okay? Because I think that is where I can add more value to you. Second, am I right? There are only 2 people who have startups of their own? 2? You and you, right? Only 2? Yes. Is anybody else thinking of that? You should all think about that, okay? Always keep that option open, because that is where I suspect a lot of these things are going. I'm talking about investing in the age of AI. I'm not talking about society in the age of AI. But if I was, I would be talking a lot about that. Okay, that's a different topic. All right. Now, so this course that I have here is unusual. I have an unusual teaching style. I've been doing it for a long time, and I've decided a long time ago that I'm not going to subject myself to the standard way of teaching. So I like to do the things that I know is useful and slightly different. I will be recording my lectures. I'm being recorded right now. You will not be recorded, and whatever you say will be removed. You don't have to be. I know that people worry about that, so that's not going to happen. I record them, I edit them, and then you can watch them. I tend to put them on YouTube. I have a very active YouTube channel. I have the most boring YouTube channel ever because I have lectures. 3-hour lectures, 4-hour lectures, 1-hour lectures, but I have them there. My students found them very useful, and that's why I do it, okay? And the course is, I'm going to be focusing on topics in business and finance. I'm also going to be talking a little bit about math. I'm going to talk about a little bit of AI, okay? A little bit about AI, but especially I'm going to talk a lot about common sense and being street smart, which is a very important ingredient when you get into the investment sector, okay? It's a mistake to think that investments happen because you have the right algorithm. As we will see, the algorithm will empower you, but the weakest link in your chain is not going to be that, okay? So I'll try to make that course very practical from that point of view. The course has a website. I think you've been sent to the website. The website is my method of communication with you. If you go to the website today, you will see that there is one set of lecture notes, which are the ones that I'm doing today. You don't have the ones that I will be doing tomorrow, because those I will finish today. Now that I know who you are, I like to make my course adapted in that way. I know what I was going to do, but now I will finish that once I know you. But they will be there tonight, and then you can see them. And everything that develops, which is unexpected, I have an almost unlimited supply of material, which don't worry, it's only 20 hours that we're doing together, okay? Not the lifetime. But I will, any other material that I think is useful, I will put it on the website so you can go there. And that will be there forever. So in the future, if something was there which will be useful for you in a year, it will still be there. All right. So now, my teaching style is very North American. I like to engage in conversation, and you are expected to participate. We are going to be doing lots of discussions. We're going to be doing role-playing exercises too. And which is gives me a wonderful opportunity to learn your names also, right? But today, what I want to devote my whole day today to explaining what investing is. And I start with a very, audacious quote of myself, which is, I like to say that investing is turning risk into return. You can see that Warren Buffett does not think the same. He thinks risk is something to be avoided. I said, no, risk is something that you have to take. There's no such thing of if you're investing unless you take risks. And that's where being smart matters, because you need to know what risks you're taking. You need to know if the risks have an adequate compensation. And then once you adopt a risk-based point of view, then a lot of the finance you've learned can come into play. AI will be a great enabler for that, to understand what the sources of risks are. And today what I'm going to do is I want to show you all of that in what I think is the most effective way. We are going to create an investment company together. By 6 p.m., we will have an investment company. And if you want, you will all have a job. Okay? That's what I will do. And I'm going to do that because through that lens, I can explain to you what I call the life cycle of investing. An investment starts like a person with a conception, which in our case is going to be the why we do what we do. And it's going to be in the world of ideas. And that's going to come onto earth, and that's the birth of the investment concept. And we're going to see today how we do that. And then it's going to grow. We'll see how that does. And then it's going to die. And we will see different types of death, from very good to very bad. But all investments die. Okay? We're going to see that, and we're going to do that, like I said, with a business case. And this is a case which is based partly on something that happened, partly true, and part fiction. It's the fiction part that is interesting, as is usually the case. And that's what I will do today. And my business case has to do with the city of Montreal. Montreal, Canada, it's a city which is known for one very important aspect, which is the snow. The city of Montreal spends $100 million, over $100 million a year cleaning up the snow. I don't know how that works here in Zurich or in Switzerland, but the way it works in Canada for most Canadian cities is this works on a fixed rate, on a fixed contract with a cleaning company. Companies, they do a bid. We're going to assume that the bid is for a year, usually for 5 years. It doesn't matter to us. Okay, so the city says, who wants to clean up my snow? And then the companies come and they bid. But when they bid, they charge a monthly fee. All right? Let's say I want to pick $10 million as an example of a monthly fee. And then what the city has to do has to decide when that starts. So let's say $10 million is the price. Will you buy that contract for the month of August? No. Will you buy that contract for the month of April? Well, not in Zurich. But in Montreal, maybe. Maybe. In fact, it happened in Toronto in the year 2003. Toronto has a similar system, but we spent less snow than Montreal. In 2003 in Toronto, we had the following event. We had a snow precipitation. It was very serious. And we do what we always do in Toronto when there's snow, which is we wait for the sun, which usually comes up in less than 24 hours, and the snow just melts away and it disappears. That year, it did not disappear. After 3 days, traffic was impossible. Some grocery stores were running out of food, so the city had to call the cleaning company, who cleaned up the city very quickly for 1/2 of next year's budget. Of course, they're not going to give you their best price. Before you negotiate, yes, but after you call them in an emergency, they'll charge essentially whatever they want, right? That's the risk you take. And April, it's for Toronto. In Toronto, we don't have April in our contract. Montreal may. I actually don't know that. But the cities have that problem, which is that they need to make a decision. The snow plows that clean the city, and you have the picture there, these are, they don't belong to the city. They belong to the companies that just do the cleanup. It's a very comfortable deal. You pay money and then they clean up for you, right? And then you can worry as a city about other things which your city should be worried about. Museums and concerts and parking and this and that. All right. So the question is, what do you do in this situation? Because if you somehow make a mistake, if you choose a month which is not needed, you're going to spend a lot of money, $10 million. But if you don't, and you get a snow event, then you're going to spend a lot of money. So this is a typical problem that cities in Canada have. You can imagine that every city will have spending issues like this, right? Okay, so the interesting situation here is that someone had an idea. I suspect a lawyer. I don't know the person, but someone had an idea. Hello. Someone had an idea that you're going to have to get a chair. Yes. Someone had an idea, which is that the ski resorts have the opposite problem. And this is a picture of Mont Tremblant. It's a ski resort 135 kilometers from the city, Montreal. And they have the opposite problem. They're very happy when they get snow in April or May, right? They're very unhappy when they have no snow at Christmas time. That's a big one. You know why. So this person had an idea, and the idea is, let's do what's called a snow swap. Let's look at the city with their snow problems, and let's look at a ski resort with its snow cash flows. And let's do the following. We do a deal, very simple deal. If there is snow, the city will pay. If there is snow, if there is no snow, the city will pay the ski resort. They save some money, so they share some of that with the ski resort. And if there is snow, the opposite will happen. It's a way to decrease both of their risks. Makes sense, right? Great. This is actually true. This actually was proposed, and it was drafted as a contract between the city and the ski resort. And then picture that. They showed up one day, the city with their legal team and the ski resort with their legal team. They're ready to sign. They were agreeing with the terms and conditions and everything, except one. There was one that was not agreed. They did not agree where they were going to measure the snow to determine if that was a snow event or not. The city said, we measure at the city. The ski resort said, no, we measure at the ski resort. City, ski resort. They couldn't agree. They couldn't agree. These things happen very often. This is what's called a market inefficiency. When people are close to agreeing, but there's one tiny feature that they can't agree upon, then many times this leads to deals just collapsing, like in this case. And this deal was not signed. It died. So this is where the truth ends. Now I'm going to start with my science fiction. And the reason I'm going to do that is because in the science fiction world, I will come up with a fantastic investment opportunity that is going to be not only able to help us create our investment company today, but it's going to help us refer to, as an example, a very good example that we will understand very well for the rest of the course. We're going to come up with a business case that will help us understand investing from the ground up, not from textbook down. All right. You have a very good point, and that is what I will discuss today when we talk about data science and how to do this the right way. What you're talking about, I suspect, is a very good point. Many people go skiing not because they snow in the ski resort, but because they snow in the city. Is that what you're saying?
I mean, they would pay if it's snowing in the city, right?
Okay. So maybe we're not understanding each other, but you said something very, very interesting, which I will bring up now, because this is real business. People go skiing not when there's snow in the ski resort, although you do check, but when there's snow in the city. Snow in the city encourages people to go skiing. Okay? So that's a very subtle consumer issue, which I'm going to ignore until a little bit later. I'll talk about some of these nuances at about 5 p.m. today. Okay? But for now, I'm going to assume that things are a bit easier, and the ski resort just cares about snow at the ski resort, so people kind of ski up and down. And the city cares about snow in the city because that's what they have to pay to clean up, okay? But you are right. The actual, we take this into practice, there's some subtleties that we need to be aware of. They're coming a little later. That's a very good point. Thank you. Thank you. So back to my science fiction. Let's assume that I was there that day. I'm in very weird meetings very often. Let's say that day I was there. And they say, wait. don't go away. This deal is about to be broken up. I said, please don't go away. Stay there because I have an idea. This is what I'm going to do. I'm going to tell the ski resort that I will do a swap with them as they want it, measuring the snow at the ski resort. And I'm going to do a similar deal with the city, the same, but I will measure the snow wherever they want at the city. Okay? Then they're happy. So sure, I will do that. And I will do that. Why? For money. I'm going to charge 10%. I'm going to assume that they're happy with my 10% fee. I'm providing, this is what's called a liquidity provider. Or for those of you who know about investment markets, I've completed the market. And I'm going to charge for that, 10%. And I'm going to assume that they're very happy with that. All right? Understand? Good. Now, the city is happy. The ski resort is happy. They got the deal they wanted. Am I happy?
Yes.
You think I'm happy?
No.
No? I don't know. Let me ask. Let me ask all of you here. You're,
Well, in the city, it's less likely to snow, and in the ski resort, because it's higher up, it's more likely to snow. So yeah, you're happy.
I'm happy. Great. Okay. Let me. Who would participate in this? Who would say, yeah, this is. You're happy to be the intermediary. Raise your hand. I want to know your. When I say raise your hand, like raise your hand. There you go. And who says, no way, no, you don't participate in that. Okay, you don't. All right, so let me get into that. And what I'm going to do is I'm going to act as people do investments. All investments are done like that. You look at the cash flows, what could happen and what happens in that case, right? So I'm going to start, and this is where I'm opening a kind of worms now. I'm going to say that there is some correlation between snow in the city and in the ski resort. Okay, and half of you are doing very fancy AI and LLMs and this and that. So what are you talking about? This is the wrong assumption. I know, I'll fix it. Okay, but we're going to start with something very simple, see how far that goes. I'm going to start with an assumption of a 50% correlation between the snow event in the city and in the ski resort. You all understand what I mean by that correlation? Everybody knows correlations? Yes? You know correlations. Great. So if there's a 50% correlation between the ski resort snow event and the city snow event, what does that mean in terms of the probability of my cash flows? How good are you with correlations? You told me that you know correlation. How good are you? You know what the probability is that I have the exact same event at the city and the ski resort if the probability is 50%? The number is 75%. You know how to do that? I'm sure you all know. You've done this a long time ago. You were probably little babies when you were doing that. Maybe you forgot. But if you have that event, this is a Bernoulli distribution with 4 events, 2 correlated events or 2 correlated coins, right? If the correlation is 0, I'll remind you, okay? I think I don't want to lose anybody, by the way. That is against my religion. I don't lose people when I lecture, okay? Everyone has to follow me. And if you don't, you have to raise your hand and I'll make sure that I bring you back with the group. If the correlation is 0 and I flip 2 coins, what's the probability I get heads?
50.
Heads.
Heads,
25, exactly. The probability I get tail heads.
Also 25.
Tail.
Also 25.
And head tail. Oh, 25, exactly. That's with 0 correlation. We're very good at that, right? What if the correlation is 50%? Heads, more than 25. But maybe we don't know how much. But if I gave you enough time, you could do that, right? Or you can download some Python package somewhere that will calculate it for you. Either works. And the answer is that it's a 75% chance that I get the same snow event in the city and in the ski resort. So 75, why? I'm telling you, you have to solve a system of equations. The answer is 75. But you've done more complicated things than this in whichever probability or statistics course you took decades ago. Am I right? Yes? If you know what correlations are, you should be able to calculate that. For right now, at 2:36 p.m., I'm very happy with you believing me that the answer is 75%. Great. What's the probability? Because something else could happen, right? I could actually receive payment from both. There's no snow in the city and there's snow in the ski resort. And someone mentioned, was it you? That the probability, yeah, that was you, right, exactly. You think that's yours? Well, it actually should be more likely that there's snow in the mountain than in the city because of some meteorological event. Okay, I'm not going to go there. I'm not going to get so refined with my investment analysis yet. Okay, so I'm going to say if the probability, if the correlation is 50%, there's a 12.5% chance that I get the opposite events. One of them is great because I make money from both, but there is a 12.5% chance I have to pay money to both. Right? Now, how much money do I have to pay to both? Well, it's 10 million and 10 million, 20 million, right? So who was in favor of doing this deal? I forgot. Don't go back on your decision. You were in favor of this deal, right? You wanted to do this deal. Are you prepared to lose $20 million with a 12.5% chance? Forget about the money you're going to make. Actually, no, that's not true. You're going to lose $18 million. Are you prepared to lose $18 million with a 12.5% chance?
At the moment, no.
Sorry?
At the moment, no.
No, okay, so then you change your mind. You said you would be in favor, but now you're not in favor.
You just ask some people for some money with those numbers. I mean, they can make money too, right?
All right. So we have a real business leader here right now. Okay, so that's great. But let's stay with that assumption. It's your own money. Would you do it with your own money? We will learn today there's a huge difference when you invest, whether it's your own money or someone else's money. Big difference. But we're not there yet. We're still getting to that. So let me first say, would you be happy to make this investment with your own money? Does everybody understand what I'm talking about? Imagine someone just gave you $20 million right now. $20 million, all the things you could do with $20 million, right? And then...
Do we have this deal for 1 year or do we have this deal for 20 years? Like, I mean, 12.5% depending on...
That's a very good question too, but I want to say just for 1 year for now. Just for 1 year for now, because look...
Well, it's better than in the casino.
It's better than... Oh, I don't know what casino you go to, but yeah, this is better than most casinos. You can still, but look, I mean, there's a 12% chance you lose $20 million. Anybody here has $20 million? I mean, look, you can pretend anything. You can pretend you're Elon Musk today. There's no problem. So anybody has $20 million? You don't understand what I'm saying.
Meet somebody.
Okay, right here. And your name was? Alia. Kalia. So Kalia has $20 million. Exactly. So let's say only 20, okay? Only 20. So would you put your money in that investment?
So
it is true you're going to make some pretty nice return, but it's 12%.
We started with assuming a correlation of 50%. We can do better.
Well, I mean, I'm working with these numbers. Of course, if the numbers change, I'm getting to that. I want you to understand the possible pain of losing $20 million. I don't know if you think about that very often.
I mean, if we think about it as a positive expected value, so we should, at least in theory, gain money.
Yes.
But the problem is that it has a huge downside risk, so we need
yes, exactly. So
risk or expected shortfalls, so it has a
right, exactly. So right, so I can.
From the terms of Sharpe ratio is not the best one.
Right, exactly. So all these things are coming up. So you just mentioned very important terms. You mentioned expected shortfall, you mentioned Sharpe ratio. All of those things were invented precisely to make decisions like this. right? In fact, let me do what investors do. Investors are very disciplined when they look at these situations, all right? And I forgot your name? Annika?
Yes.
Okay, so you are in portfolio management at your bank. So I'm very likely you do things like that. Okay, let me run through the numbers. That's what people do. Just run through the numbers, right? It's a very, if you treat investments in a very passionate way, it's so hard. But if you treat them in a dispassionate world, it's much easier. By the way, this is one of the areas why AI actually will help us, because it helps us remove the passion from the act of investing. So let me just go through the parameters. Very, very simple. The invested amount, we always start with the investment amount, okay? The investment amount is $20 million. An average rate of return is 10%. And the volatility is 50%. The volatility, I assume you know what it is. It's that, the standard deviation. You know that, right? You know that?
Yes.
Everybody knows that? Then everybody says yes. You see? No, not everybody knows. Okay, not everybody knows. Who does not know? 3 events, right? One has a 75% chance of happening. My deviation from the mean is 0, right? Because I make the money, which is the mean, is my 10%, I make my $2 million. Another event, 12.5% chance of making 20 plus the fee, 22, 110%. And the last event, 12.5% chance, I lose 18 million, 90%. So the variance of that is 0.25 about, which means the standard deviation or the volatility is the square root of that, which is about 50%. Yes? All right, so I think you're all with me. The volatility of this investment decision is 50%. So professional investors, they like to look at the Sharpe ratio, which you mentioned. Your name?
Patrick.
Patrick. So Patrick told us that the investors like to look at the Sharpe ratio, and the Sharpe ratio in this case is 0.2. It's the division between the expected return, 10%, and the standard deviation, which is 50%, 0.2. And a Sharpe ratio of 0.2, who are the professional investors here? Annika is one. You do this for a living, so. Yes, say yes, yes, exactly, yes. Anybody is a professional investor here? Okay. No, only her? Well, a Sharpe ratio of 0.2, you can't convince your boss. I mean, your investment officer said, no, give me something better. It's not good enough. You may agree or disagree. You may come up with many different ways of looking at the risk and the return, but investors typically, when they see a Sharpe ratio of 0.2, with the probability that you lose everything, which is 12%, no, not defensible. Okay, so why am I telling you that? Why am I here telling you that? Well, because I can have a better idea. It is a bad deal. But the better idea starts when I consider something different. I have to take a break now or what? No.
Up to you.
No, I prefer a break a little bit later, okay? Because we're about to hit a home run right now, and then we take a break, okay? It's anticlimactic to have a break now, because I can have a very good idea. Because see, I'm a business guy. I told you I'm very street smart. I said, this is a great idea. I wish I could do this all over North America. So as I'm there with the city of Montreal and Mont-Tremblant, I'm thinking, I am doing this deal. But I know I need to hurry up and talk to 99 other cities and 99 other ski resorts and do the same deal over and over and over again. You know why, right? So I'm going to pick those as my cities and ski resorts. Imagine 100 of them, okay? Imagine 100 of them. And then the result is what? It's a portfolio which is going to have, what are the investment parameters? How much money I need? I need $2 billion. Who had 20 million? Someone had 20 million. You had 20 million. How many people have 2 billion? Here. I give you an opportunity to have $2 billion and you don't raise your hand. There you go. Exactly. Your name? Shuki. Okay. Shuki. Yes. Shuki, you have 2 billion. You have 2 billion. He has 2 billion. Exactly. Anybody else has 2 billion? Okay. Well, no, I think I'm in the wrong city. Okay. 2 billion and 20 million. Okay. So you have 2 billion. Great. So I think I'm there. I think, I remember Shuki. He took my course in Zurich in 2026. I'm pretty sure I can convince him. Okay, so I say, yes, I think I'm going to do this, right? Understand? Because now, what's the average return is still 10%. But what's the standard deviation? What's the volatility of that? I think you all know. Because these are independent events, it drops by a factor of a square root of 100.
But they are not really independent, are they?
Okay, let me see. They'll give me a sub ratio of 2, by the way. Okay, so professional investor here, Annika says that's a wonderful investment, so I want that. So let me see what that means. Are they independent? Let me think. Some people may think, what about if I have a very cold winter? If I have a very cold winter, then I'm going to end up very cold, humid, so a lot of snow. I'm going to end up giving a lot of money to the cities and getting a lot of money from ski resorts. Right? But on average, they will still cancel out. If I have a very warm, not very much snow, I will be giving a lot of money to ski resorts that I will get from cities. So they're pretty independent. I said pretty independent. I didn't say they're independent. That is, the modeling. I'll have to ask my AI experts. I have many of them to choose from here to tell me what it is. But they're pretty close to independent because, you see, my losses will be a function of the deviations between two close by places, right? So certainly this is not exposed to global warming, for sure. Might be exposed to other things, but not to global warming. So for now, we're still within the first hour of the course. I'm going to assume that they're independent, yes? And then I have a very, very good investment opportunity. One that is going to make 10% return, a standard deviation of 5, sub ratio of 2. And I don't know, Shuki, you interested?
Yeah.
This is good, eh?
Yeah.
You're going to make $200 million a year, right?
Yeah, exactly.
That's for nothing, right? All right. So we just finished the first part of the life cycle, which is what's called the conception. We have the idea. And it typically happens like that. I'm there, said, I think I can do this. Now is when the fun begins. Because let me tell you, I don't have $2 billion. I'm full of ideas, but my pockets are empty. Very typical situation, by the way. Okay? But I have the beginning of a business. I'm going to explain to you what the business is. And this is how my investment product will be born. This is leading to the birth. Now, you see, I went very fast because a lot of issues were brought up. Are the cities and the ski resort, the altitude? I ignore that. I ignore some nuances between the cash flows and this and that, right? I ignored many things, but I got to a finish line that looks very promising. Do I have the ability to execute this to invest your $2 billion? The answer is no, I don't. I need to talk about the business of how we do that. So we can take a break now. Yes, okay. We can take a break. How long are breaks here? You have to teach me these things. I don't know. 10 minutes.
15 minutes, but you can do 10.
Let's do 10 minutes. We come back here at 3 because I'm in a rush. We're going to make so much money that I'm in a rush for you to come back here in 10 minutes, and then I'll tell you how all of this actually will make all of us very wealthy. Okay? 10 minutes. So here's where we are. I had a good idea. I want to try to turn the idea into money. I cannot do it alone. It's illegal for me to turn this idea into money alone. I have an idea. I have a very good investment opportunity for $2 billion. I forgot your name already.
Shuki.
Shuchi, exactly. Shuki.
Or Shuchi, both fine.
Shuchi, which one?
QI, both fine.
Shuchi. Okay, Shuchi. So Shuchi has $2 billion. Okay, and he needs someone to tell him what to do with the money. I know that. Kalia has 20 million, right? The rest are poor, so you will have to work. They are the ones with the money. You are the ones who need money, right? And I'm the one with the idea. So it's illegal for me to talk to you and say what some people think is possible. Say, well, you have 2 billion, I have this investment opportunity. You cannot do that. It's illegal. Depending on which country you are, you will have different types of punishment. You do this in the United States, it's lethal. You go to jail, it's bad. Why? Because managing business, managing someone else's business, if it was my money, I can do whatever, I can burn it. I can do a bonfire and then just burn it. Actually, in some countries that's illegal too, by the way. No, it's because it's the money doesn't belong to you, it's just a promissory note, it belongs to the government. So. But you understand what I mean, right? I can just, but if it's someone else's money, this process is very highly regulated. You cannot just do that. And there are entire countries whose business is precisely that, just to create infrastructure so that investments happen. One of the most famous ones is Luxembourg. Luxembourg, all they do, sorry, this is on YouTube, all they do is create infrastructure so people manage someone else's money. And they don't do it because they don't know how to, because they don't care. It's much easier to just create infrastructure. So what I have to do is I have to create a company and I have to create a fund. The fund is the legal way for my investments to happen. I have to create a fund. I'll tell you a little bit about that. But let me tell you what a fund is. A fund is a legal structure. This is not a course on law. I'm not going to get into the fine details of what legal structure it is, but it's a legal structure that has investors who own it. In this case, you guys are poor. I only have 2 investors, Kalia and Shuchi. Yeah, okay. How much money? I need 2 billion. You have, give me some numbers. How much do you want to invest? No, you invest your 20, you invest 1.8. Okay? 1.8 and you're 20. 20 million, 1.8 billion. So I have 2 billion. That's what I need, right? So instead of 4 investors, I have 2. So you own it. This is your fund. I create it for you, but again, I cannot create it personally. I had to do it through a management company. I have to create a management company that will be managing the fund. So some of you said, who wanted to work in a hedge fund? You? So Michal, right? You wanted to work in a hedge fund. Well, that's what a hedge fund would be. You work in, forget what bank. Annika, you work in a bank? Well, the bank has these funds for sure, right? Exactly. So this is how you manage other people's money. It's like that all over the world. In the whole world, it's like that. Pick a country, it's done like that. So I need to do that, and I need a management company. The management company could be located really anywhere. Because I live in Canada, I will create my company in Canada. Maybe. Because I'm going to need employees for my company. I'm the CEO. And maybe I own the company, I am a 100% shareholder in that company. But you understand the difference between the fund and the company. The company has no money. I'm poor. The fund has $2 billion from theirs. But my company has nothing. Some people think that the hedge fund is the management company. No, the hedge fund is there. It's the one with the $2 billion. It's their company. My company has nothing. My company has one good thing, an idea, what is called IP. But I need to hire people. Okay, so I accept application. I'm not going to tell you what kind of people I know, but you are not going to tell you what kind of people I need, but you know what my business is. So can I have volunteers who want to work for me doing something or other? Can I have volunteers? Yes. Simone, yes. What?
Yes, I want to work for you.
Thank you. What do you want to do for me?
I can negotiate the contracts.
Okay, you're my lawyer. Okay? Okay, so I have a lawyer. I need a lawyer. Right? Good. So you're my lawyer. Simone, you're my lawyer. Okay. However, it's a regulatory requirement that I have someone who is, call it Chief Investment Officer. Is the person that is legally responsible for making money for the investors, and in particular, the one who has the obligation to represent the investors' interest every time we do something. By the way, this person, if they don't do their job, they can go to jail. Because this is a requirement, it's a legal requirement. Who wants to be my Chief Investment Officer? You want to be my Chief Investment Officer. Very good. He's very smart. Dario. Yeah. He's very smart. And this is something I want you to learn. He's taking a job that has a lot of risk. And I know why. He hasn't told me how much he wants to get paid. And it's not small. I know that. Am I right? Yeah. So his job is very risky. Very risky. He makes a mistake, the investors can sue him personally. He goes to jail. Okay? But he's going to make a lot of money because of that. We'll come to the salary in a minute. Okay? So I have my Chief Investment Officer and I have my lawyer who negotiates contracts. By law, I need another person. I need a Chief Compliance Officer. Could be you. But since I have a room full of people, I'm going to invite someone else to be my Chief Compliance Officer. This is the person who ensures that the investors' money is well kept, not because they make the right investment decisions. He does that. But because we follow the law no matter where we are. Who wants to be my Chief Compliance Officer? You guys are not going to succeed in the financial sector. I can tell you that from now. Okay? When someone offers you a job, you raise your hand like faster than the person next to you. No, it's true. One of the reasons I teach how I teach is I want this to be helpful for your career. Your career will not exist if you don't get a job. And you don't get a job if you don't raise your hand. That's how it works. So, sir, you're hired. You have the right CV. It's wonderful. But you know you're taking a big risk too, right? You are the Chief Compliance Officer. You're the one, if something goes wrong and we break the law and say, oh, you did what? Well, it was an investment decision, that'll be his neck. But if it's something else, it's your neck. So I'm not going to talk about your salary yet. I'll come to that, okay? But now I have the bare minimum I need for my company. I have my lawyer, who, for this is critical. You have to negotiate and fight the lawyers of the City of Montreal and all the cities, right? And get me the best possible deal. We'll talk about that. We'll talk about the deals that you can get. You are the one who has to make sure that the investors' interests are responsible, because these guys are vicious, okay? They're vicious. If you misrepresent them, they sue you. Yes. And same thing for you. But, I mean, we're going to make $200 million in profits, we expect, right? So that's going to be...
And what is your risk in this whole setup?
What is my risk?
Yeah, you seem to have the best job.
Okay. Okay. Yes, I do, by the way. Yes. But we're coming to that because I haven't told you how much money I'm going to make. In fact, I haven't told you how much money you're going to make. And we only know how much money they're going to make. You understand that? I want you to understand how everybody's going to make money here. And that's something, whenever I teach, I always tell the students, there's two types of decisions in your life. For people who are like you, I'm going to say that you're mathematicians. I know that some of you are not, but which is you can follow the equations so you can follow the money. Sometimes they are together, but sometimes they're not. And if you follow equations, you will make a lot of equations in your life. And if you follow the money, you will make a lot of money in your life. And you need to know where they are. Because in universities, we typically train you to look at the equations, right? Well, in my course, I'll train you to look at the money. Somewhere. Understand? All right. So to see that, let me show you the ecosystem of my fund, because my fund does not only have the management company. I'm going to need a bank, because after all, I have to put the $2 billion somewhere, right? So the banking business is very important for that. Where shall I put my money? Which bank? Well, Zurich is a very good destination. There's a lot of good banks here.
Not that many anymore.
Well, that's their problem, you know? In fact, anybody wants to be my bank. You want to be my bank. Good. Your name? Chue. Chue. Oh, Chue. Okay. So you're my bank. Chue Bank. Yes? Okay, so we're going to give you the $2 billion. I'm not going to ask you how much money you charge, but it's going to be small. Okay? But you're my bank. You're $2 million. Okay? So I have my bank. I need a broker. Well, not for this fund, but in general, when you're investing, you need a broker because you need to trade securities. In this case, we don't need to trade anything. Essentially, you are my broker. You're the lawyer. You're the one doing contracts. But you have to buy bonds or sell bonds. You need a broker, right? Who wants to be my broker? You're learning. You're beginning to speed up okay, so I'm going to choose Annika because she works for a bank, but you're next, okay? So you're my broker, all right? You're going to be helping me buy and sell securities and this and that. And we'll see how much you charge me. Okay, we're coming to that. Next, I'm going to need an administrator. This is a very important person. Sorry, it cannot be a person. Very important company. This is the company whose job is to count the money. Who wants to be my administrator? You are. Okay, great. This is very important. You're going to count the money. I'm managing your money, right? And I should inform you how your money is growing, if you're making money, if you're losing money, right? Who determines whether money is being made or lost? Who does it? It's a mistake to think that the management company can do it, because I will be encouraged to lie. You will not be happy with that. You're a very smart investor. So no, you need an independent valuation, right? So you are going to, is that you, right? Yes, you are my administrator? Yes, okay. Your name? Eduardo. Okay. So Eduardo is going to be my administrator. He's going to be the one that counts the money.
But you're also paying the administrator, right?
Yes. Oh, no. Yes, the fund is paying the administrator.
So at the end of the day, they are also kind of biased or inclined to tell the story like a bit nicer. Like when they do the accounting for the...
No, he doesn't care. He gets paid the same whether he makes money or loses money. So, sorry, Kalia, you lost all your money. He still gets paid. No, he's really disincentivized from lying. He doesn't care. Yeah, but I am incentivized, as you're about to find out. Yes.
So the bank does get paid, the administrator gets paid?
Everybody gets paid. Everybody gets paid.
If the fund loses money, everybody gets
paid. Everybody gets paid. This is the beauty of the asset management sector, right? Only the investors lose. Right? Well, if that's the one thing you learned today, that's good. Okay? But I need to get into the guts of that. All right? Very important. Yes. The administrator, of course, gets paid. Now, it turns out that dealing with the administrator, you're the one that counts the money. How do I know that you are doing it right? It's your word that matters. It's not my word. These guys will not believe my word because they know I'm conflicted. So, oh, it's great, you're making so much money, give me more. No, they only trust yours, but I need to check the way you do. So for that, I need in my company, I need a chief financial officer, someone who's going to be your counterparty, who does what's called a shadow valuation inside my company. Of course, it's verified by you. And you may have your fights until you agree on the valuation, but I need someone who's my chief financial officer, who wants to be my chief financial officer. Good. Tristan, great. So you're beginning to exercise that. This is good. This is how you build a career, okay? You have to do that. You are my chief financial officer, okay? By the way, I'm gonna forget very soon all the employees I have. You have to remind me, okay? This is how it works. You're my chief financial officer, and your job is to count the money. But it's not your word that matters, it's his word. He's the one whose calculation will be sent to them, not yours. But you're the one who you have to check with him, okay? Great. So then I have an administrator, and I need more. I need also an auditor. Why? Because administrators sometimes they make mistakes. You have no incentive to lie. It's not a lie, it's a mistake. And the determination of the value of the fund is important because as investors come into the fund and leave the fund, we need to make sure that they pay the fair amount, right? Mistakes are very serious in this business. So to prevent mistakes, I need an auditor, someone who on an annual basis checks that what the administrator did is correct. Who wants to be the auditor? You already had a job, no? Oh, you didn't have a job? You are the auditor? Oh, I thought you had a job. Okay, you are the auditor then. Michelle, you are my auditor. Okay, so you check that what the administrator is doing. Eduardo, right? Yes. Okay, I cannot see your name from here. Yes?
Who will check him?
No one checks the auditor. The auditor is the ultimate authority. Yes. Of course, these guys, they have horrible fights once a year. They fight each other. What do you mean I made a mistake? I didn't make it. You made a mistake. And then he's the one that's just watching and said, no, I think he's right. And then they said something like a three-way fight, right? In the end, it's his word and his reputation that matters.
And if the mistake happens, even the auditor didn't see it, but the vicious investment guys realized it, who will be sued?
Oh, it depends on the magnitude, but the administrator can be sued. Yes.
So the auditor,
the auditor is somehow like the ultimate authority. I mean, if the auditor does something, the auditor can break the law, and then they will be sued. And then the administrator stops and said, "This guy, don't believe him. He's lying to you." And I said, "Okay, are you sure?" Yes, I have proof. Or damn, then you know lawyers. You're a lawyer, right? So let's find a lawyer, and then we sue. That's how we would do it. And everybody makes money. Different amounts of money. My bank, Sure Bank, will charge me a little bit of a fee, okay? The broker, you were the broker? Yeah, you would charge me every time we trade a stock a few pennies, right? Okay, we do that, that's your business. You're gonna be very important on Thursday, okay? A lot of money on Thursday, oh, too much money. On Thursday. The administrator is gonna charge a little bit, not too much. 5 basis points maybe, okay? But it's good money because you just have to count the money, right? And then the auditor is going to charge a few $100,000 and that's it, okay? You're the auditor, right? Good. And, but now to understand how much people in the company get made, I need to understand how much does the company make? I mean, I think that was someone's question. Why am I doing this? Sure, I like these guys, they were my students, and I like them to make a lot of money, but so far it looks like we're doing all this thing for free. And that is just not right. Now, there's one very important thing that I have to say here before I get to the money. Look at all these service providers. It's very, very important that they are conflict free. For example, Eduardo and Michelle should not have any type of business relationship. Like you're a Pricewaterhouse audit, you're a Pricewaterhouse administrator. I don't like that. You have to be different companies, right? A broker. There was a case, you may know of this person's name, is coming up later, Bernie Madoff. Have you heard of Bernie Madoff, very famous in Switzerland, very famous in Geneva, actually. The biggest scandal in hedge fund history, $65 billion that disappeared. Right. Well, he was at the same time the manager and the broker. This is the guy that created the NASDAQ exchange, so he knows how to fake broker statements, and he did. Send them to the administrator. There was just some buddies of his, and then everything was a big lie, and he sustained that because there was a conflict between them. So we'll see more about that later. Okay, so these things, they have to be very clean. All of these, we need to have a very respectable investment ecosystem, and all of this is supervised by some people who are called directors. These are people who they have no operational role. They don't do anything except supervise. And if something bad happens, say the management company, me, I'm caught in a big fraud case, and the directors can take over the fund. Okay, so the directors, have you heard of the company called Long-Term Capital Management? Have you heard of them? Yes, you know them. Long-Term Capital Management rings a bell? No. Do you know the directors of Long-Term Capital Management? They had two very famous directors.
Just now they broke up.
They blew up in 1988. Yes, they blew up in 1988. Well, they had two famous directors, Myron Scholes and Robert Merton, the Nobel Prize winners in 1997. They were directors. Their job was to, if something bad happens, they are the ones who say, wait. They took over the fund. And these are things which are established by law. The laws of funds recognize some people who they're not employees. They just are paid like $50,000 a year, something like that, for the work of every quarter, check that everything is okay. Most of the times are okay, but sometimes they're not, and they have some responsibility. Now, we're not going to spend a lot of time with that. I want to talk about something else which is very important, especially here in Europe, which is to create these things in practice. I have to now take the following thing into consideration. So you're going to invest $1.8 billion in the fund, and you're going to invest $20 million in the fund. Great. Where shall I put my fund? It's a legal structure, right? So I could have the fund domiciled in Switzerland, very, very frequent destination. I could have it in Luxembourg, very frequent destination for European investors. I can have it in Cayman Islands. Is the largest fund destination location in the whole world. I can put it in Hong Kong. I can put it in Singapore. There's many, many places to put it. I can take it to Malta. Where shall I put it? Now, this deserves big chapters in decision making. In fact, this leads to something very important that I'm not going to spend a lot of time on in this course, which is called offshoring. It makes a big difference for investors where their money is invested. Let me walk you through some examples. Let's say that I'm Canadian, my management company, I told you, is in Canada because I live there. Are you Canadian? Hiring you may be a problem, so maybe I need to have a subsidiary in Switzerland, okay? But at least my management company will be in Canada. Yeah, both passports. Fantastic. She learned. You can this whatever you like. Exactly. Perfect. You can have 50 passports, no problem. Okay, so shall I put my fund in Canada? No. So my bank says no. Suez says no. Why? Exactly, because of the tax. If I put it in Canada, are you Canadian? No. Good. So you'll be very upset. Very upset. What's going to happen is, as you make $200 million, because the fund is in Canada, I will have to withhold 15% of that. So about $30 million will be withheld and not given to you. Of course, you can file with the revenue agency in Canada and say, that's my money, give it back to me. Maybe they agree, maybe they give it back to you, maybe they disagree, you have to sue them, and then maybe you get it in 10 years. You are entitled to that. You're not Canadian resident, you should not pay taxes in Canada. But believe me, dealing with Canadian tax agencies is certainly not fun. Okay? So if I put my fund in Canada, they will not invest. Where shall I put my fund?
Cayman Islands.
Okay, so now this is very, very interesting. Let me spend a little bit of time on this. This is more important than it seems. I have no slides on this. I have a whole course on this, but not for this course, but not for today. But let me spend a little bit of time on this. This is very important. You said Cayman. Why Cayman?
This is famous for hedge funds.
It's very famous, yes. And why is Cayman famous? Because they yes. Okay, so let me change your language. Okay, it's not tax-free. It's tax-neutral. There's a big difference, right? And this is a common misunderstanding. The taxes that anybody will pay is a function of your residence. It's a function of you. And the thing is that Cayman doesn't care where you are. They're not going to withhold any taxes. There's no tax withholding. You will pay taxes wherever you are. But in most other jurisdictions, there's something called tax withholding. If your fund is domiciled in a certain country, the country will have laws for tax withholding. And most countries have tax withholding. Then good luck getting that money back. Yes?
How much is it here in Zug or in Switzerland?
I don't know. You will know better than me. But Switzerland will have tax withholding. 15%. So if you're
It also depends OECD, like which country you are, like.
okay. So this is very important. Very, very important. So for example, just like I would not put this fund in Canada because my investors will not be happy. Let me just imagine you're Swiss.
Yes.
You're Swiss. There you go. And you are Chinese, exactly. So if you're Swiss and you're Chinese, what I will probably have to do is I'm going to open up a master fund, which is going to be in Cayman, because Cayman is the easiest jurisdiction to do this, the easiest. So I create a fund in Cayman, but now watch, you will not invest in that, even you will not invest in that. What I want to do is I want to create what's called a feeder fund. My first feeder fund is going to be in Cayman, also a Cayman fund that will invest in my other Cayman fund. You invest in my Cayman fund because you are a resident of China, and then when you make a lot of money, you receive a statement from the administrator, says you made all this money, and then you file your Chinese taxes, you pay your 15%, and you're good. But there's no tax withholding from Cayman. And for you, I'm going to create a fund in Switzerland, because you don't want to go to Cayman, because if a Swiss invests in Cayman, the Swiss tax authorities, they investigate everything about you, and you don't want that. Okay, investing in Cayman is dangerous in Europe because you are a suspect of tax evasion. Although it's not illegal, it's completely legal, but you're a suspect. Europe wants to discourage people from going to Cayman to invest. Yes?
I didn't quite get why people would invest in the one Cayman fund, but not in the other.
Yes, I'm coming to that. I'm coming to that. You will see. You will see. So I'm going to create a second feeder fund, which is a Swiss fund. And that's where Kalia is going to invest, because you're very happy investing in Switzerland. You will have tax withholding, but that's going to be part of your whole tax declaration for Switzerland anyway. So for you, it's not an added burden, but for you, it'll be horrible, right? They're going to take, you're going to make, what? You're going to make $180 million. They're going to withhold 15% of that, right? Then you have to fight the tax authorities to get it back, because you have to pay in China, right?
Better set a company in Hong Kong.
Whoa, yeah, okay. Now we're getting very refined. I can see that I'm dealing with experts. That's fantastic, yes. But that's how it works. Now, the reason I do a Cayman fund separate from my master fund is because I'm going to commingle. I'm going to join her money with his money into a single fund. So when Simon goes and negotiates the swaps, you only do one contract, not two, right? You see, if I put all my assets into the same master fund, then you only negotiate one. Otherwise, you have to negotiate two, because each fund will be a different legal entity. So everything goes into the same master fund. So these are feeder funds. The only thing they do is they collect money and send it to my master fund. And in that way, I can cater to investors everywhere. If now I have my Canadian investors, I can create a feeder fund in Canada, goes into my master fund in Cayman also. And then we manage, my management company manages a single fund, not many funds. Makes it operationally very complicated. Yes, Eduardo, yes.
Considering this is still there's no fund, right?
Yes.
Okay, considering we are dealing also with the government, for example, the city of Toronto, would I be happy as the city of Toronto to dealing with maybe a less transparent structure or?
Oh, okay. Wonderful question. Wonderful question. So, the city of Toronto will not care. Will not care about many things. The city of Toronto will care that you have a fund which has assets, and we'll talk about that in about an hour. Very important, okay? Because she's going to have a big fight with the city of Toronto, and her fight is going to make us so much money. Oh, you will see. It's going to be great. You talk about transparency, and I wonder why you said, I'm going to throw the question back at you, right? To say that the city of Toronto will not be willing to deal with someone which is not transparent, okay? I suspect there you're making an assumption, which is that my Cayman fund is not transparent. Okay, that assumption is wrong. Whether you're in Cayman or not, that has nothing to do with transparency. Now, it is true that if you want to do money laundering, which of course you should never do, and I hereby forbid any money laundering happening in this course. If you were going to do money laundering, if you want to do some illegal activity, maybe you go to Cayman. Frankly, it's easier to go somewhere else, not Cayman. Okay, Panama, for example, is a better destination. Okay, but I'm not getting into that. I'm certainly not giving advice as to where to do money laundering. Cayman is actually one of the most reputable places for fund location, and the reason is that they are an overseas British territory, so they're subject to British law. They're as good as London. And that's the reason that British Virgin Islands and Cayman are such big destinations for these things, because of that. Because British law happens there, and everybody trusts that law, everybody knows that law, and nothing funny if you go to Malta. I mean, Malta has engineered their legal system so that it welcomes this type of structures. They've also replicated the British system. And that's what countries do. They set themselves up so that these funds would naturally go there. They set up legal systems so that these funds go there and everything fits perfectly. And that's what Luxembourg did when they realized that Germany was unable to create an investment fund structure because Germany cares too much about their taxes. And they didn't want the investment industry to screw up with that. Luxembourg said, oh, we're a small country. 90% of my income is going to come from that new business called investing. I'm happy to put my manufacturing tax at risk because I have none. Understand what I'm saying? And countries do that. That's how they engineer the country. And doesn't matter which country you live in. Switzerland did the same. They all engineer. It's part of the business plan of the country to engineer their legal system so certain businesses are attracted to it and others are not. Okay? And that's how, and we do the same. When we create my investment structure, we do the same. We go wherever it is good for me to do what I do. And Cayman is the place where I would naturally end up, because no one here is German, by the way. If I had a German investor, I would probably have to create another master fund in Luxembourg because they are obsessed with Cayman. They think Cayman is the ultimate destination for money laundering. And you don't want to deal with the German tax authorities, by the way. Okay? Yes.
in the case that we have this German situation, if you open a fund in Luxembourg, then you're gonna still merge it with a master fund in Cayman, or
No, I would not. I mean, this now we're getting very, very detailed, and this is not a course on. But I will tell you, I would not do that. I would keep my Luxembourg fund as a Luxembourg fund without any investments outside of Luxembourg, because that triggers.
So another contract then.
Yeah, and then I'll tell my lawyer, sorry, Simon, now you have to deal with two. It is going to cost more money. You're absolutely right, and that's why it's inefficient, and that's why you would not like to do that. You would like to avoid it, but you have to deal with the situations that you have, and in this country, that's what you do. Okay?
But would it not then make more sense, instead of going to the Caymans, just say, okay, we do everything in Luxembourg?
No. First of all, well, actually, my Chinese investor will not care. In Luxembourg, some of the earliest funds they got were from China, actually, at the same time as Germany. But let me just say that Luxembourg is so bad and so expensive that if I can avoid it, I go to Cayman. Very fast, very cheap. Luxembourg is bad, expensive, and slow. But anyway, now we're getting to very fine, too many considerations. But I want you to understand this, because this is critical to the business. This is how businesses are created. And I suspect you deal with that or similar things to this on a daily basis. And in particular, when it comes to offshoring, this is something which is very oftentimes misunderstood. And I want to tell you, investing offshore, for example, we have the best pensions in the world in Canada. Ontario Teachers Pension, Canada Pension, they cannot invest in Canadian funds. They cannot invest in US funds. They can only invest in offshore funds without tax withholding. Why? Because they have such a large diversified book. Actually, they can invest in Canadian funds with some exceptions. Why? Because they are so international. Canada is a small market. Our pension plans are very big, and Canada is a very small market, so they invest in the US, they invest in Europe, they invest in Asia, they invest everywhere. And they always invest through Cayman. It's the only one that ensures they don't have to file tax returns in 50 different jurisdictions. They have, no, this is my Turkish tax return, this is my Bulgaria tax return, this is my India tax return. No, they only invest in jurisdictions which are in tax neutral jurisdictions, like Cayman, for example. And that's why Cayman is so, they make so much money, the tiny island because all of this makes money, right? If my master fund is in Cayman, my administrator will be in Cayman, and Eduardo will have a Cayman office to manage this in Cayman. And we don't have an outside legal firm, but if I have an outside legal firm, they'll have an office there too, right? And that's how Cayman is so rich, because these things have very high leverage from a business perspective. Okay, so I think we understand this process very well, am I right? And now note that every one of these will have their own investors and have their own service providers too. I have to have my administrator there and my auditor, so Michelle is going to have offices all over the place. And that's the investment infrastructure, and everybody makes money, thanks to the two of them and my idea. Okay? Now, let's get into the fun part of all of this. And this is perhaps the most important thing I need you to understand today. How is this actually making money, and why did I bother to do this? So to do that, I'm going to suddenly tell you that, by the way, I don't work for free. Neither does my employees. We all have to charge. Let's get into how much we charge. So I can say that the management company is going to charge a very, very normal amount, which is 1% of the assets under management, which will be $20 million. And 20% of the profits we make. Let me show you that, okay? I have a little table here with the numbers. So I'm going to do two columns, the column of the investor and the column of the manager. The manager is I'm going to say me, but it's actually my management company, all of us. And then the investor, which is Kalia and Shuchi. Shuchi. Yes. Okay. That's your commingle, $2 billion, the two of you together. So after a year of investing, I forgot your name, my chief investment officer, Dario. Dario has wonderful choice of investment. You negotiated fantastic deals with the city. So $200 million are made. So you make $200 million, but wait, you have to pay everybody now. Okay, I'm just going to go with a big ticket item, which is my company. The rest, it's just small. Bank Schwab is very cheap. There's no problem. Okay, so we're going to ignore that for today. I'm going to charge you $20 million. And by the way, when I say I'm going to charge you, that's going to go through my administrator. That was Eduardo, right? My chief financial officer, it was you, right? Tristan, right? Yes, because your screen went blank. Yes, yeah, Tristan. So Tristan is going to say, hey, you owe me $20 million. You go there and say, well, then you look at the contract. There's a contract between the management company and the fund, which I'm going to show you. So, yeah, you're right, $20 million. So here you go. And you send a check. And you send it to another bank, Schwab Bank also. Well, I'll give you other, okay, you have the banking business of the management company also. But then you are going to say, wait a minute, I made you 200 million, you pay me 20, so you have a net profit of 180 million. So you're going to send an additional invoice for $36 million, which is 20% of that. You receive that, you said, yes, 20 million. Sorry, 36 million, yes, here you go. And you receive another $36 million check and you deposit that into the Schwab Bank again. But in fact, you see the money just went from the Schwab Bank to the Schwab Bank. I'm continuing because I cannot stop now. We're making so much money. This is the worst moment to stop. No way. So we have that, which means that my company has made $56 million that year. And you guys have made $144 million. So you made 200, but you had to pay $56 million in expenses. Okay, he's so sad. I can see that. Damn. I need to find a cheaper service provider. But I said, no, look, we are the best. We are the best. Yeah, you have no doubt. We are the best. Right, Kalia? We're the best. Great, perfect. But that means that you're no longer making 10%, you're making 7.2%. Still good, eh? Still good. Because that's 7.2 in addition to interest rate. You do realize that if I had interest income, say 5%, then the 2 billion will make 5% on top of that, right? So that's going to make me, wow, that's $100 million right there, on top of everything. So the 7% is pretty good. It's in addition to the risk-free rate of return. Great, perfect. So at this point, it's quite clear why I'm doing this. It's good money. Now let me ask you a question. For each and every one of you, which column do you like better, the investor column or the manager column? You're the investor, you don't get to opine. The investor column has an advantage, which is you don't do any work. This is just your money, and the people are making money for you, and you continue with your own, either your own business or you're on vacation the whole time. So the advantage is that you make money really for free. The manager column is attractive because it makes a lot of money from nothing, from very hard work and lots of good ideas. So naturally, every one of you should be more attracted to the manager column because that's why you're here. This was not a course on being rich in the age of AI. If that was the course, then you will all be here in the, right? But you should also know that every one of you is also in the investor column somewhere. For example, you all have a pension of some sort. Maybe directly, maybe indirectly, maybe because you are citizens of a country in which maybe you make pension contributions. So that makes you an investor, even if you contribute only €5 or something. You're all here at some point in your life. And the world is divided into investors and managers. Always. Or the service providers who provide services to either. Okay? If you are a manager, as you're about to find out, we're going to have to, the advantage you will have is if you're closer to the investor column as much as you can. And for that, I need to now go into my employees and decide how much you get paid. Allow me to discuss that. This is very important also. Okay, I know that I'm not doing any segmented regression or anything like that, but it's very important to understand how you get paid. Okay, so let me start. I'm going to make 56. This is very good business. And by the way, everything that I told you, I was envisioning as I was in that meeting with the City of Montreal and Mont-Tremblant that day in April. Okay, and I knew I would be hiring someone to do the contracts, and I have $56 million in my head. I said, this is fantastic. This is a great business. I want to do it. What is the most important employee I need for my company? And it's not someone I have hired yet.
Accountant?
No. And by the way, I already have an accountant. That was Tristan, right? You are my CFO, right? Yes, he's my CFO. He's my accountant. No.
The second.
No, that was him. That was Dario. Yes. No, I have that. My salesperson. How can you have a business without a salesperson? Right? Yes, I knew you guys because you were my students. I called you up, but I need a salesperson. Why? Because they need to take you to dinner. They need to send you your birthday card on the day of your birthday, right? When you get married, we need to be there with great gifts, right? We need a salesperson. Who wants to be my salesperson? Okay, right here. Sorry, he's closer to me. Osaze. Osaze? Yes, okay. So you're my salesperson, right? You have an advantage. You know them too. In fact, you're sitting right in the middle of them. So when I say, I think they will invest, you say, oh, leave it to me. And you convince them. And not only you convince them, you are the one who, when something bad happens, you call them up. I said, oh, bad news. But don't worry, it's going to be better. Or when something good happens, oh, let me take you to dinner, right? You do that, that's your job. And you do that on a daily basis. So I have to pay you for that. How much shall I pay you?
A lot.
Well, yes, of course, a lot. Yeah. So before you answer, let me give you the algorithm. The algorithm you have to follow to determine your compensation. Decide in which row you are. Which is your row?
Invested amount?
The 20 million. They are your invested amount. Thanks to you, I'm making $20 million in my company, right? So on the basis of that, tell me how much you want to get paid. You learned that in my course, how to get paid, okay? This is very important.
$1 million.
$1 million. Thank you, sure. That's great, yes. $1 million, there you go, perfect. In fact, why don't we write it as follows? Why don't we say 5% of the revenue, of the management fee, right? Because if for whatever reason you don't do your job and he only invests $1 billion, right? You lose $500,000 right there, right? So I pay you, yes, 5%? Oh, no, that's bad. Okay, how about this? I give you almost nothing. I give you a fixed base, 150,000 francs per year, right? And 5% of the management fee. How's that? In a bad year, you make 150,000. I know it's not enough to survive in Zurich, I know. But, well, what can I tell you? If I receive zero money from my company, then I mean, I'm taking losses. This is now my money I'm paying you, right? Say yes, it's a good deal. Actually, it's a very good deal. You charge me too little on the management fee, but I'll take it. That's okay. Okay? But now, how much shall I pay my chief investment officer? There are two people who are taking a lot of risk here. How much shall I pay you?
1% of the total returns.
1% of the total return. No, I don't understand your language now. So let's see, I have to pay you on a manager column, right? So which is your row?
The second.
Your row is the performance fee. That really is your row. I could argue that the management fee, some of it belongs to you too, because if it wasn't for you, I'm illegal. I cannot even raise money, and Osase will have nothing to say. He cannot even call them, right? But you are really on the performance fee column. So how much would you get paid? Let's say a fix of 150 Swiss francs per year.
Okay.
That's the fix. But then?
Bonus.
Yes, the bonus. How much? 10% of the performance fee. How's that?
Yeah, 10%.
Yes. Settle for 10. That's okay. We negotiate tough for some other day. Okay? 10%. That's your salary. How about you, Simon? What's your column?
Negotiating your idea, right?
You're on the management fee row. Your row is the management fee, right?
Okay. Now, what is the management fee? I would like to have 20%.
20% of that. That's $4 million. It's a little too high. I'll give you 2 million. Okay, great. How much do I pay my CFO?
A higher pace and very risk averse.
You are actually paid a flat fee. I'm not going to pay you either a portion of the management fee or a portion of the performance fee. I know that is very disappointing, but what can I do? I mean, you just come, you do your accounting, and so I pay you 150 Swiss francs per year, and that's it.
No more.
More?
Yeah.
Oh, how much?
350.
Fine, I'll take it. 350. That's fine. Okay? You understand how everybody is being paid? Yes? My compliance officer. What's my compliance officer? That was you, right? How much shall I pay you? 200K? No, too little. No. Too little, okay? You're taking big risks. If something goes wrong, you go to jail. For 200K? No. I will pay you.
Willfully lies, then I'm not accountable for their lies as well. I can just say that they lied. If chief investment officer.
No, I know, but if my company does a mistake, for example, I'm making this up, okay? No offense, okay? Turns out Kalia's money was not her money. And we didn't check. In fact, she works for a very well-known terrorist organization.
But is it in the management fee as well, right?
Yeah. So you will be. I think you should get $1 million at least. Well, 1 million Swiss francs, or pick a currency. Yes, you're taking risks, and you have to understand you're taking risks, right? Sorry, no offense there. Okay. No, but these things do happen. These things do happen. You know, the source of the funds was, money laundering is very typical, and if you are involved in that, it's very bad. That is very, very bad, right? And then, so yeah, and you're the one in charge of that. You have to get paid very well. It's your neck, right? Yeah, you understand what I'm saying here? And these are all jobs. Now, this is very interesting because I have you all here. You're all experts in, ML and AI and this and that. Where do you fit into this? Why are you even in this course? This that I'm telling you is what is not going to change in the next 50 years, maybe in the next 100 years. This is not going to change. By the way, when was this created? This infrastructure I'm telling you about now was created around the year 1700. the investment world as we know now was created around the year 1700 in England. That was the big contribution of England to modern finance. They created the investment structure, of which a company with its limited liability structure and lots of other things arise from. And why did that happen? Because of the Industrial Revolution. The Industrial Revolution is what created the need for people to get together and pool assets together, not to invest in snow swaps, no. To pool assets together so that they could create a company that would go to Canada, kill seals, get the skins, bring them back to Europe, and sell them as clothing. That company is a Canadian company known as the Bay. It went bankrupt 2 years ago. It was created in 1689. This thing that you're seeing here was created as part of the Industrial Revolution. And it's still there today. And I suspect it's going to be there for a long time. Now, it will change. I don't know when. It will change once you get, for example, someone was doing something in digital finance. Who was that? That was you. Okay. So if you now look at this world in which you can have, for example, fractional ownership, you can have a blockchain settlements and this and that, this could change. But right now, all of you, it hasn't happened yet. And that's going to be perhaps very slow because changing legal structures is a very slow process. So whatever we discuss in this course, where AI or anything like that will change things, it will change many, many things, but not this. His job as salesperson is not, it's going to be enhanced, as we will see. But you're still subject to the same rules and the same compensation. And the chief financial officer, same thing, and the chief investment officer, the same thing, and the auditor. That is not changed yet. No, it's not even challenged. So we started with the part that is not going to change in the age of AI, and that will release me from figuring out how with AI we can change things, knowing that this will not change. Okay? So let me quickly, and now we take a break. Okay? I will quickly just end with the legal setup. This is the end of the birth, and then we're going to the growth. So these things that I'm telling you here are established into a legal document called the offering memorandum. The offering memorandum is a legally binding document between the investors and the fund. When the investors want to know how their money is going to be treated, everything will be there. So the fees that we charge will be there. How we're going to value these assets is going to be there. The liquidity provisions when money come in and out is going to be there, and so on and so forth. All of that is captured into this document, which investors must read and agree before investment takes place. Okay? All right. We're going to take a break. When we come back, we're going to change. There's going to be a change of scenery again. I'm going to take it from here, but now I want to start to deal with other types of considerations. For example, how we value our portfolio valuation. That's coming next. 10 minutes. I'm going to continue with, with the different aspects of what we're discussing here, but I wanted to pause and make a comment, which is about how this course is going to be marked. You have to get a mark, and I'm surprised no one asked so far. It's my least favorite topic of discussion. Okay, but I know it's important, and we're in a university, we're regulated, and we have to do that. What I like to do is, I have a principle. I like to always mark my courses based on assignments which have a life outside of the course. I think of good assignments as an asset that you own. I'm into investments, so I think of an assignment as an investment, which I can use to give you a mark, but also as something which becomes a business card for you. And I know that if you go to a job interview and as part of what you have done, you've worked at this bank, you had this experience, and if you're able to show a piece of work which defines a very interesting piece of knowledge, that works very much in your favor. And I like to give assignments which satisfy that aspect of it. So I'm thinking of something that you have, under your arm or on your website. I say, well, I did that. Okay, and that defines you. That defines who you are. That defines who you are. So for this course, what I was imagining is, imagine you write your own book. Imagine the title, Investing in the Age of AI. Imagine that book, you flip through it, and then all these wonderful things that we're discussing here are there, right? And some of the things that I'll discuss later today and tomorrow are there. I know that will be a fantastic asset for you to have when you go to a job interview, for example. So that's what I would like to demand from you as an assignment for this course. And I will give you a mark based on that. It's almost like a job interview more than a mark. You see what I mean? You understand what I'm trying to say?
You want the book?
Yes. I want the book. Don't ask me how many pages, because I don't care. I want you to understand how I think about the assignments, and then we'll make it consistent with the laws of the university. Okay? I always do that. I start with a big idea, and I do this wherever I teach. Do you understand the idea? No? Have you been to a job interview? Yes. And how does the job interview go? Oh, I went here and I did that and I did that, and no one really knows what you're talking about.
I mean, they do like assignments too, right? They test if you can do what you say you can do.
Yes, yes. So I want something which is there, has your name, very important, has your name on it, the first page, your name. Title, I suggest Investing in the Age of AI, your name. And then I will tell you, I'll give you exercises you will see throughout the week that you can do, and they just put them into the essay, and it's going to look great. It's almost like a fill in the blanks kind of exercise. I'll tell you how to start and then you finish. Understand what I'm saying? And then it can look great. You can even print it, hardcover, wonderful colors. That's up to you. I don't care about that. It's up to you. But that's what I would do. And then you go to the job interview, I did that. So that's what I'm thinking.
When you need to submit it?
I forgot. I knew that. Do you remember? No. It's in a few weeks. Let's say by the end of April. I don't know. I like to wait until when you need to. So I need the marks tomorrow. That's when it's due. Okay. Not something that I need by Friday. In fact, no. Frankly, if I was you, after you submit to me, if it's really good, I would keep working on it. It'll help you in your next job interview for sure. Okay? So you have to send me an assignment, one PDF, one number of things, and what will be in it, I will be giving that to you throughout the course. You don't have to have everything that I suggest. It's too much. But you may like that, you may like that. They will all be different. And they will all be marked based on the quality of what's inside, not marked based on what's missing from it. You decide. It's the book of your life. It's your book. Understand what I'm saying?
Can you send us an email with the deadline?
Yes, I will find out. That's not my decision, but I will find out. I'll work with him and then we'll send the... In fact, I will not send you an email. I will post it on the website. Because although I think I do have the ability to send an email to you now or something, but it's just easier for me. I'll post it on the website and I'll put the instructions and maybe And by the way, and I hope this is okay with this university, not only that I allow you, you're encouraged to use a ChatGPT or equivalent to do it. All of my assignments require the use of ChatGPT. And I like to give assignments that the LLMs cannot do. I love it. I love it. Yes. I sometimes I give assignments where the LLMs get it wrong. I love those even more. But this is not that case. This is something which is not, you use an LLM, is totally fine. You're the one who is dictating what should be in it. And I want to give you here the ingredients, which are, the LLMs don't know what I'm telling you. Okay, by the way, they haven't managed money. The LLMs have not managed money. So they don't know what I know. If one day LLMs manage money, they will learn lots of things and maybe they can do this, but right now they can't. So, okay? All right, good. Good. We're done with that. All right, so let me move on. And now perhaps I'm coming closer to what this course was expected to be. And let me ask a question. I say here, valuation principles and methodologies. So let's say that I have my $2 billion portfolio, and it's now, let's say it's April, so you invest. At the end of April, I have $2 billion from you. At the end of May, I have to send, who was my, you have to send them, you have to send them the investor newsletter, said how much money they have made in the month of May. What do you say?
The month of May?
Yeah, you have to send this letter every month. You have to, it's required by law. You have to send a letter every month saying, this is how much money you've made in the month of May. Interest rates are zero. There's no interest income, okay?
I guess May was a quiet month.
Well, the thing is that this is not your decision, right? Who decides how much money they have made? You send the letter, but it's not your decision. Is everybody following this, right? Yes?
Wait, what the financial...
Yeah, who decides the finances? The
Administrator?
The administrator. Eduardo is the one. So you have to ask him. So Eduardo, what number shall you give him in May to report to our investors?
What number?
Yeah, the value of their investments, $2 billion. They're investing $2 billion. In May, how much money do they own? What's the value of their shares? What's the value of their investment in May, at the end of May? Yes, how much?
It's, I would say, 2 billion.
Okay. Does everybody understand the question? You have to report. You get a letter. You've received. Who has invested in your life? Commercial investing. Yes, and they send you a letter, right? Dear such and such, lots of numbers. The value of our investment today is 5 francs, and that's what it is. 5 francs, right? Yes. So we have to send it to them. So how much would that be worth?
So it's 2 billion plus the delta, probably of the contract that.
We know the contract. The contracts are swaps, right? Based on snow events. Yes. So let's make it easy. Let's make it easy. No, so we're in April, May. We're going to report what happens in May. Let's say that the May is not one of the months in the contract. We would do not even in Montreal, they will do a snow contract in May. So there was no contract activity, no cash flow activity in the month of May. What will the report say? How much money do they own of their $2 billion investment? This is a very important question. Okay, before you understand, so let me pause. Who has taken a course on pricing theory? Many of you are in the quantitative finance program, right? Okay, who has done Black-Scholes theory? Have you heard of Black-Scholes theory? That was part of a course that was called pricing, right? Yes? No? Mathematical Foundations for Finance. What did you do in that Mathematical Foundation for Finance course?
Develop all the tools to develop the Black-Scholes.
Okay, so you develop, what is the Black-Scholes model? It's a model that does what? Does pricing, right? So you have seen pricing. Pricing is not something new to you. Everybody has done derivative pricing here. Derivative pricing? Have you never done derivative pricing? Raise your hand if you have never done derivative pricing. Okay, so then you don't know what I'm talking about. So you don't know what I'm talking about. The rest of you know derivative pricing, right? Yes, okay. Those you have seen, do you know what a stock is? A stock, yes? Okay, No, I need to know. I just met you. I don't know. I need to stock. No, I don't know what a stock is. Okay. You know what a bond is? Yeah. Yes. Okay. And you have a portfolio. Have you seen? You know that there are portfolios of stocks and bonds, right? And those are how do you value a portfolio of stocks and bonds? Do you know how to do that?
Depending on the weight that you assign for each asset.
No. It's very simple. What?
It depends on the market value.
You use market prices, right? When you have a portfolio and the administrator has the portfolio, says you own 5 stocks of ABC and you own 3 bonds of BED, right? So, well, the stock is worth this much, the bond is worth this much, you add, and that's the value. That, yes? Everybody has seen that? Yes, okay. And sometimes you have some securities which are very sophisticated, like options, and then you need some sophisticated methods to value them. Perhaps Black-Scholes, perhaps. We're not sure. Yes? So there's a whole body of mathematics that has been developed to value financial securities. Yes, a whole body of mathematics. Accounting is very simple, stocks and bonds, that's accounting. Sophisticated mathematics is when you deal with options such as, for example, options, call options, barrier options, yes, interest rate swaps, right? Swaptions. Yes? Okay, great. So all of that was developed so that people like Eduardo can do their job at the end of the month. Sometimes he deals with very simple securities, stocks and bonds, then does a very simple multiplication and sends a report to my CFO, who then sends it to Osase, who then writes a very nice letter, beautiful colors, company logo, and sends it to the investors. All right? And that happens for most funds every month. For mutual funds, sometimes even every day, but certainly once a month or once a quarter, right? Yes? Okay. Now I'm dealing with this investment fund we created here with snow swaps, which are wonderful, and they're going to make a lot of money to my investors. Those of you who took mathematical foundations for something, did you see a chapter on pricing snow swaps? Exactly. So how does Eduardo do his job? How is he supposed to do it?
Well, he has different options. He has different options, no?
He has different options.
Yeah. I mean, he can just take the whole investment and take off the management fee part and says this is what your thing is worth, your investment.
Okay.
Or he can account for the expected return in the future a little bit. I mean, depending.
Okay. Well, thank you very, very much for your answer. Thank you very much for your answer. Okay, I love it. It's wrong, but it's great. You touch on all the important points. Let me touch on the points where you are completely right. Okay, she said something very important, which is, I think you said this. I think you said that he has to account for the fees which are owed to the management company, right? And those we know. The performance fee, not yet, because maybe we get paid once a year and we don't know if we're making money or losing money. We don't know that, but the management fee for sure. So every month you know that you have to give us approximately 20 million divided by 12 per month. So that's easy, right? That's discounted from the NAV, right? And everyone understands that? Yeah, this is elementary school thing, very easy, right? The problem is when it's time to value the swap contracts that you negotiated with the city and the ski resort. How do you value the swap contracts? Because my portfolio is very simple, contains cash. At Schuhe Bank, the bank is closed. She had to leave, so the bank is closed. But we know the statement. We know in the bank we have 20 million minus whatever bills were paid. But then we have the snow swaps. By the way, this thing I'm talking about is very important and it's no exception. Okay? It's a very weird context, but it's very important. Every fund manager needs to do this. I need to value the contracts. And these are not, what's your name? Paula. So you asked Paula, I said, hey, Paula, you took this fancy course. Did you see anything about notes? No. Actually, no, Eduardo, you're talking to her. No, you. Yeah. You talked to her. I said, Paula, would you be my consultant to help me price these things? I've never seen that in my life. Can't do it. So now you're stuck pricing those no swaps because they are part of the portfolio. The portfolio contains cash, which you know, because you are in contact with the bank, and these securities, which you happen to know, but you don't know how to value. The next topic I want to discuss is the concept of risk. I told you that the act of investing is turning risk into return. So let me talk about the risk taxonomy. Which are the risks that we're going to be taking here? And I want to start with liquidity risk. This is in the case of the snow swap, is something very, very important. Let's imagine that after a few months, my investors here are, for whatever the reason, they want their money back. They want to sell their investment in the fund. How would that happen? It's going to be a major problem for us, right? Because if they want to get their money back, we have contracts in place, right, Simone? And we cannot just say, well, I give you your money because I have a contract which is due with the ski or the ski resort or the city. So because of that, we will include in our offering memorandum restrictions on the investment redemption windows. So the investors can only get some of their money at the time which is pre-specified, and the chief investment officer, Dario, is going to be the one that's going to be setting this up for us. So that is a type of risk that we don't want to have in our portfolio. Those of you who know about long-term capital management, you would probably know that the risk that drew the fund down in 1998 was a type of liquidity risk. So liquidity risk is a very important type of risk that exists when you're doing investments. And well, in this case, it's something to watch out for. It's one. Now, another one is risk always lead to return. Could be good or could be bad. If the risks I take are the right ones, my assets under management will grow, and with that, the fees will grow, and maybe that's going to increase the amount of money we're going to be managing. And sometimes the amount of money that we are going to be managing can hit a ceiling. It's called the capacity limit. And then we're going to have a problem because we don't know how to manage that. Imagine I have a good example here in a situation where, imagine in our snow fund, we closed the first year with gains as expected. The investors made 7.2%. We made a lot of fees. Everybody's very happy. The service providers, the bank, everybody made money. It's great. And now, Osase has some friends. Anybody? We don't have any more rich people here, do we? No. No one. You are okay. You made some money in the last. During the break, you made some money, and your name? Anya. No problem. So Anya has some money, and you want to invest another $2 billion. Yes. Okay. So Anya wants to invest $2 billion. So you go and take her to dinner and make sure that she's happy. Yes. But then you send it $2 billion. Well, no, sorry. We have to make a decision here. We have to make a decision because I need to make a decision. And that's purely my decision. Do I want to take your money or not? What do you think? Let's ask my employees. Whoever's my employee, shall I take their money or not? I start with my chief investment officer. Shall I take her $2 billion? You think so? To invest in what? I don't have any more swaps, right?
Yeah, maybe your lawyer came to you and he negotiated or she negotiated more contracts.
Yeah. Okay. So thank you for that. But I'm now, if that's the case, I will take her money. Okay, but 100 cities and 100 ski resorts is so that will be actually that will be his decision. He's the one who will tell me if there's another opportunity. So of course, what you can negotiate. So let's say that the answer is no, I cannot negotiate any more swaps. This is it. This is all I have. This is very typical. Sometimes you just hit a limit. There's no more. There are no more bonds, no more stocks of that particular kind, right? So we have an important decision to make. This, I remind you, was the financials for my company and for the investor with my existing portfolio. But now we're a year forward. Let's say that I'm going to take the money, but I have no more swaps. So I take your money, Anya, the 4 billion right there, plus there 2. And I'm going to now charge, we're going to make 200 million profit, same as before, because I have no more swaps. Okay? And I'm going to charge now 40 million, right? To the fund. My performance is still 200 minus 40 is 160, so it's $32 million of performance fees that I charge to the fund, right? And the result is that my company now makes $72 million, but my investors only make 3%. So what happens in this case? You understand the situation, right? Was this the right thing to do? I know what my investors think. My investors are not happy at all with this. They're going to contact their lawyer. And I didn't do anything wrong. They cannot sue me. Compliance officer, you're fine. Okay? If there was nothing there that said, you know, if for example, we did not have a clause that says that you have to be 100% invested all the time, then we're fine. They're not coming after us. But they're going to see that they've been screwed. Because, and by the way, you're not happy either. Okay? We took the money and said, what happened here? Well, look, these are the numbers. Eduardo says these are the numbers and these are the numbers. They say, well, then when can I get my money back? And then you leave, and then we're dead. My fund is finished. Right? So this is a very interesting situation. It's a business situation where if I had decided to stay with my fund as it was, they probably would have been very happy investors for a long time. So we would have been making $56 million for many years. If I had done this, I would have made a little bit more money on that year, but then that's the end. We'll have to all look for another job. Yes?
But this is illegal, right? I mean,
It's legal. Yes, there's nothing wrong here. This happens all the time, by the way. Yes?
Is there a commitment that you have to be profitable around that 7%?
No. There's no commitment. In fact, we cannot make that commitment because this is not really up to us. Right? I can commit, Simon, I can commit that I will always be 100% invested. That will be reasonable. In this case, then I would be breaking my agreement here. But no, usually you cannot have a commitment that you're going to have that return because things could happen, right?
You don't take that position who is kind of like standing for the investors that we invest good, like for their.
Right. So who in the company will be the one to tell us don't do this? Certainly me. Right? Because this is the end of the company for me. Certainly me. But I mean, I'm the CEO. Who is going to be aligned with my interests here? You? Are you sure? Why?
Well, can we cut the management fees?
You make money on the performance fee. Your performance fee is going to be a little bit smaller, but very, very little bit smaller. Almost the same. And you're so good at what you do that if this fund terminates, you go to another one, you can find a job right there in Bahnhofstrasse in no time. By the end of lunch tomorrow, you have a new job. Right? The lawyer, you can negotiate. Yeah. So who will be, and you?
It's also good.
You think for you is good? Well, you're going to make more money this year, right?
Yeah.
Exactly. And then, well, and then my fund closes. But well, again, you're so good at what you do, maybe you get another job tomorrow. Maybe not with these guys though. Okay, maybe you have to find different customers.
I think always this thing that you have fiduciary responsibility to.
So, because you are not paid, actually, this does not make you any money, right? And this does not make you any money either. You're not paid a bonus. In this situation, the people who are not paid a bonus could be the ones that will object and will convince me. Because this is bad for you. You have to look for another job. I'm sure you can get another job very quickly, but since for you it doesn't matter, you're not compensated to make this decision, the people who don't pay bonus would be the ones to convince me. That's what's very important, that I have people that I don't pay bonuses to. Of course, you guys would like to be in their position, making, you know, he and he are the ones making the most amount of money in the firm, right? But this is a situation where the people who don't pay bonuses are the ones who can lead to that. But anyway, this is one of the ways to die. This is a very sweet death that you can have. But there's other deaths which are not so sweet. We have cases of fraud. And fraud is an area where, in particular, LLMs are having the biggest impact today at detecting fraud. LLMs are very, very good at that. Very, very good at that. They generate a lot of false negatives, but that's okay. It's the false positives that would worry us. And this is an area where there's a lot of advancement. In fact, there's now a lot of people like you, who are big consumers of LLMs as an attempt to find fraud detection. Okay, we'll take some more about that. Performance drag, our fund just stops making money. The investors are not interested. We didn't break the law. We just go and find your business elsewhere. We blow up. And we're going to see examples of blow up, not today, except now. We have an example of a blow up coming up. But the big blow ups that have happened are examples which are as a result of certain types of activity. We'll see them very likely on Thursday. We'll see examples of funds blowing up. And flows, just that people don't want to invest with us. You know, we just become unsuccessful. And this is actually one of the pain points of a lot of the private banks in Switzerland. Just flows. Flows are going elsewhere. And your ability to have people like you that can drive flows in is very important. And this is another area where the use of AI for investing is in the asset gathering exercise, not in the asset management exercise. This is an area which is very often overlooked. And I recommend all of my mathematician students to be very on the lookout for jobs in sales. These are jobs that mathematicians can now do very well. Okay, so just be aware of that. I'm giving you the same recipe of that. Okay, now this is the example I told you earlier. This is the guy Bernie Madoff. He lost $65 billion in investments due to a type of fraud. He created a company and he was the broker at the same time. So he created false brokerage statements that he sent to the administrator, who was a captive administrator, was only doing work for his fund. $65 billion, if he pays his administrator, say 5 basis points, that's millions of dollars for an administrator to just look the other way, right? And there was that conflicted situation between the service providers, and that's where this thing happened. Okay, I think on the website you have a very interesting letter to the Securities and Exchange Commission of a person called Markopoulos, who, before the fraud was detected in 2009, he wrote to the Securities and Exchange Commission explaining to them in great detail why he suspected this case to be a case of fraud. And the Securities and Exchange Commission ignored that letter. It's a very famous case of wrongdoing at many, many levels by everybody, including the regulators. including the regulators. Now, this was in an area where there was very little data available. We're now in an era where there's a lot of data available. And I suspect a lot of these things are going to be handled much, much better because of our use of LLMs. Okay. Now, what I have now is, in the remaining part of today, in the last hour, so to speak, is I'm essentially finished talking. What I have now is about an hour of considerations, which is what I want you to use in the creation of your own essay, of your opus magnus. Okay? Understand? So, and I will do this every day. Every day there will be a time when I speak, and then I stop, and then somehow I will get you to work, and that's what I'm doing now. So what I would suggest is we take a break now. This is the last break of the day. We come back at 5. And for the last hour, I will go through from a volumetric calculation. Is probably as many slides as the one I have done today. I don't know. I haven't counted them. But these are designed for something different. They are designed to get you something to reflect upon and something to do. Maybe to some data to collect. Okay, you will see. So the course is going to change now. So let's take a 10-minute break. We come back, and then I move into you work mode. So in this last hour, what I'm going to do is I'm going to go back to the beginning and in fact bring up some of the things that you already mentioned that we should do. I'm going to restrict myself to this make-believe case of the snow swaps before we get into other type of investments tomorrow, and to see how we would approach that problem from a perspective where we are in control of the data and algorithmic approaches that we can have. The first would be, as you can see in the structure of the portfolio that we built, there's one element which is very important. I said that we had a correlation of 50% between the snow precipitations in the city and the ski resort, and on the basis of that we created our investment thesis. Now you mentioned, I think it was you, Simon, that the reality will be more complicated because of this and that. So let's see how complicated it is, and let's see how we could address it in as accurate a situation as possible. Okay, so there are many factors that would come into play here. The correlation approach is very weak. We can do better than that. And we can imagine the collection of a database which is very rich, that contains precipitation information with features or with labels which come from elevation, the mountain uplift, also known as orography, temperature differences, storms, and some very important element, which is temperature. As you know, the difference between snow and rain is very unstable because a small change in temperature can turn snow into rain. And although there may be a very big alignment of precipitation between the city and the ski resort, a small change in temperature could create tremendous differences between the two. So the concept of correlation is clearly very imperfect. However, if we collect appropriate information, then we're going to be able to do the modeling of that a lot better. And that, as I don't have to tell you, that will translate into the cash flows. We had very simple cash flows, 3. Now this is going to give us a whole database of cash flows, and this is going to make the investment outcomes perhaps completely different. This is what we can do today. In a certain sense, the argument I gave you earlier is an argument that we would have done, say, 70 years ago, 1950, which is when this type of thinking was developed. But today we would not do it like that. we would consider a much better source of information. Each country has agencies that collect that information. Okay, if my ski hills are going to be in Canada, in the US, I would use the first two, which are the sources of information. Actually, the one in the US, NOAA, they don't do that anymore because Trump shut them down. So we don't have that data anymore. But except for these situations, we can still collect data, and we can do, and this is how these portfolio approaches are done today. And I'm being very metaphorical here. Now, once we do that, and again, all right, so maybe some of you want to like this approach of collecting data and analyzing that. And then you can do it, and then you can put it into your essay. But like I told you, there's many things, and no one is expected to do every one of these because there's too many. Okay? But this is one approach that you can take. And if you like that, if you like to understand weather derivatives and the impact of weather in portfolios like this is a very good exercise that you can do. You download the data, and then you don't have to do very deep analysis. It's all very, very simple. Okay? Then once you do that, then you start to rationalize our portfolio construction objective using the relationship between the precipitation between the city and the ski resort. And I have some way to classify that, distinguish between the strong link with equivalent high correlations, moderate link, or a weak link, where it'll be risky, very risky, to build a portfolio like that. This portfolio that we built is very dependent on the strong correlation or the strong relationship between the precipitation here and the precipitation there. In 2 days, we're going to extend these things to, for example, convertible arbitrage or other types of investments where alignment is also important. In that case, the alignment between stock and bond behavior will be very critical. Okay? Today, I'm using this example because it's richer in data and can give rise to a type of portfolios which are more aligned with what's happening in the world today. But if we think deeper into this, we realize that there's additional factors that matter also. For example, depending on how I build my portfolio, whether it snows in the ski resort and in the city the same day, or say within a day difference, it probably does not make much of a difference. And that will change my relationship analysis, whether it's correlation or some other relationship. And I can introduce lags. And the lag would have a very small impact on the portfolio or the portfolio risks. So that could be something that we're going to be considering. I can also consider feature engineering, how to use snowfall metrics, how to use indicators for temperature or storms. This suddenly becomes a very large data problem. Temperature as a feature is going to have a tremendous impact, especially on the events where we're near zero temperature, which happens to be the months where we run biggest risks. In February, there is no question the city is going to purchase the cleaning contract. Therefore, the swap will not be in effect. The swap will only happen on those days. So we may find out that the investment that we created is worse than it seemed just because of that. And this is all information that we will get looking at data, in this case, temperature data. And we may find that there's other relationships between the city snow and the snow in the ski resort. We may find that we have the correlation, which is very moderate, that there's a strong correlation only during major storms, and maybe the risks that we have in our portfolio occur during situations where no major storms are happening, and it's very small changes in temperature will create the difference in the payout. So from here, with the rate database, we will probably consider the portfolio that we built to be far riskier than what we thought. Do you understand? Okay, I'll give you lots of, not lots, I'll give you a few examples of investments where this type of considerations matter. And after you do the analysis, the picture is very different than if you follow a model-based approach. A model-based approach is one which is simple, the one that uses formulas, the one that has been used up until the year 2020, more or less. From 2020 until now, investors are starting to not use models, to not use formulas, and to do everything on a data-based framework. And in this case, what we see is that the risks that we're taking are probably higher. I haven't done it. If anybody likes it, I encourage you to do it. It will be very interesting to see the impact. On risk will be much higher. The profitability will be a lot less for these no swaps if you do it this way than the way we did it here the first 3 hours. I'm pretty sure. Okay? So that's it's an exercise I encourage you to do. Now, after you're done with that, you can still conceptualize the results that we have obtained using regression methods. There could be logistic regression when it comes to a snow occurrence. I'm assuming you know about logistic regression, but it doesn't matter if you don't, because I'll tell you anyway. Today, I just want to give you the summary of this. Or we can have a linear regression or some version of that, maybe ridge regression, maybe back regression, when it comes to our desire to understand the snowfall depth, for example. These would be techniques that you already know that could be used in this context. Okay? Or we could go beyond the use of correlations and identify even more complex patterns. And this is what data science can do for us. Things that I do not understand, but neural networks will be able to tell me. And then when you do that, now you have a 100% neural network based decision-making investment engine. Okay? So you can picture that. Okay, all right. So that's one aspect. Let me talk about another one, and this is it's gaining a lot of popularity now, which is to understand investments from a causal perspective. In fact, this is an area I'm very active myself on. I spent the last 3 years working on this. In finance, up until the year, everything changed in the year 2020, by the way. 2020 is the year when these things started to change. You may have seen factor-based models. For example, the Fama-French model. Are you familiar with that? Have you seen that? Those of you in finance, have you seen the Fama-French model? Yes. Okay. Okay. So the Fama-French model is a typical example. It's a factor model where I give you some factors, and these factors explain what's going to happen in the markets. Okay? All right. Today, the biggest juice we can get from factor models are those where the factors are not given by Euclidean variables, but by graphs, by causal graphs. These are graphs where the different factors in it, each of them implies another. And the result that you obtain is very different. This is, causal graphs, I have a very simple one here. I've created some new ones myself. I've written some papers on it. I know I'm not intending to show you very complicated causal graphs, but I want you to understand the concept of causality. It's very different from the concept of factor models as you have seen them, and I'll try to explain to you what they are from a simple perspective. But you can imagine, if I have a situation, and this is very important now because you need to understand what's going to cause and how that will impact your portfolio. If you have a portfolio of only stocks and you try to understand which are the events that will cause stocks to go up or to go down, traditionally you will have models like Fama-French. But now you have other types of effects, like for example, you can even have geopolitical events affecting stocks. And these are areas where we are using large language models for that. And you can use, large language models are very good for that. They're very good to build causal graphs. And I will show you how to do that, not today, some other day, I'll show you, okay? We're gonna show you how to get the causal graphs and how to get the causal betas and how we can use that to do simulations and how we can do portfolio simulations from a causal perspective and understand which are the elements that will cause this behavior. This is great, by the way, for salespeople. Because now with large language models, we can link events that we know of to portfolio performance, okay? So that will come later, all right. And in that context, they say concept of causality, which is called the do operator. And this is in the context of randomized trials, which I'll show you how to do this, but this is something which is changing the way we think about finance from a traditional perspective of factor models into ones which are now based on our ability to get causal relationships. Okay. Once we do that, we will be able to generate future P&L scenarios which are not going to be given by statistical distributions but by causal distributions. The result is different. And this could be used to create generative models when it comes to investing. So I'll be discussing that. Okay? All right. Now, I have a very good example of what I just said here coming up. It's a real example. Also, everything that I said has an instance in this situation. So imagine that my chief investment officer who left is reading the newspaper in December of 2009 and then sees this piece of information here. This is taken from the newspaper 2009. It's from the Canadian newspaper, the Global Mail, and the report says, how did Intrawest rack up so much debt? And then goes on to talk about the debt levels of Intrawest. And then the question is, who cares? What is Intrawest? And you can ask ChatGPT, and ChatGPT will tell you exactly why this is very, very bad news for our portfolio. ChatGPT will tell you that Intrawest owns about 60 ski resorts throughout North America. And in fact, if you check our portfolio, you will see that a lot of the ones in our portfolio are ski resorts which are owned by Intrawest. How is that bad for us?
They won't pay us.
Hmm?
They won't be able to pay us.
They won't be able to pay us. So at this point, we start to pray for global warming. Right? Do we want to pray for global warming or we want to pray for global cooling? Which one do we want? Let's get that risk right. If Intrawest goes bankrupt, what do we want? We want that winter to be cold or warm.
Cool. So they get money from the cities, right?
If you have it's tricky, eh? So rule of thumb, if someone is going bankrupt, you want to be in, yes, Yvonne?
You want to be the one paying them. And
Exactly, that's what I was going to say, exactly. So you always want to be in the position where you pay the bankrupt entity, right? Because if the bankrupt entity, you expect they will pay you, they're not going to pay you. So you want to be in the situation where the city is paying you, who has good credit, and then you pay the bankrupt entity. So we want to be able to pay them. And I think we'll pay them when we have warmer weather, right? So yes, when I see that news in the newspaper, I want to pray for global warming, at least for that winter. Understand? But of course, prayers don't really work when it comes to investing, right? Those are for other things. So this could be a situation, this is what I will call a blow up for us. Okay, I told you we will see a blow up. This is a blow up for us. And the blow up is very easily calculated by just doing the same calculation we always do. We're going to be hit with some defaults on the payments. I'm going to assume that this leads to a $60 million loss, which maybe does not look like a lot, but this is a real killer because the fund will still have to pay us $20 million management fee. And Chi and Kalia will not be very happy at all. Not that they lose 60 million, is that they have to pay us 20. Sure, they don't pay us a performance fee, but they lose $80 million and we still make 20. Right? And this is how the asset management world works. Everybody in the investment ecosystem, they will make money no matter what. Except the investors. They are the ones who will make money when things go well, but they will lose money when things go bad. And this will probably be the end of our fund. This is what we will call a blow up. We didn't lose a lot. We only lost, you only lost 4%. Not 50% like the people who invested in London Capital Management, or 100% like the ones who invested in the Madoff fraud case. But this is enough. And the thing is, and I like this example because this is linked to a factor which is not explained in quantitative finance circles. Sure, you have the discussion on credit risk, and this is an example of credit risk, but it's a credit risk with a lot of systemic risk attached to that, because there is a single entity that causes the default of all of my of 50% of my counterparties. You understand? And if you have seen systemic risk, this is a very good example of that. And this is an area which, I've known this for years, but this is an area that I could have solved with LLMs. LLMs would be the ones to tell me that this is a risk factor that I had not realized. You see that? An LLM will see that there is it's not a counterparty of mine, but there's a common risk factor amongst many of my counterparties, which if they go, my whole portfolio gets debalanced. And an LLM will do it, yes. I want to mention this example because this is one where the detection of intra-West as the... Look, if a professional investor will know, I knew when this happened. But even if you don't, the ability of LLMs to come up with this information which is out there is a very useful use of LLMs for risk management purposes. And today I only want to give you examples. We're not going to develop anything systematic. We'll do that today, tomorrow. We'll do that tomorrow, the day after, this and that. But this is a very good example in this case. Yes,
so
Simon.
We had a cold winter, and that's why we had the minus, right?
Right. Yes, because the money we were supposed to get from the securities we just don't get. Right? So the risk taxonomy, when you're making investments, and I remind you, an investment is turning risk into return. So we better understand what the risk is. Okay? So the taxonomy is, we have market risk. Market risk is the risk of losing money due to market events. Securities going up and down in price. Credit risk of counterparties not paying, like the one we just saw. Liquidity, as we saw earlier, we have no ability to turn our money into cash, and London Capital Management is a good example of that. We'll see that on Thursday. Tomorrow I'm going to devote it to just look at mathematical techniques, okay? And I think it will be very easy for you because I think you have a very, very quantitative background, all of you, so that'll be very easy. But there'll still be a few surprises. I hope. Surprises are good. And then legal risk. Legal risk is legal risk is there, and AI is not going to help us either to detect it or to manage it. Let me just move on. This is not important for us today. And the other one is operational risk. That includes fraud, mistakes, and this and that. And here, the large language models are very useful to detect some of that. Like, they're very good for fraud. As you know, I mean, essentially fraud is very similar to detecting a spam email, right? You just look for something that's suspicious, and then LLMs are good for that. Okay, so some additional considerations before I get into my last example, and then we end for today. Okay? 4 hours is very tough on me. It's even worse on you. I know, okay? Listening to me for 4 hours. I want to mention it's something about the vocabulary, but it's very important. It's the distinction between speculation and arbitrage. I mentioned, and I always will say, that you need to take risks to make returns, always. But the risks are of different types. Risk, we saw the risk taxonomy earlier, but you have two types of risk. Risk which are diversifiable and risk which can be mitigated, okay? The hedging is the act of mitigating the risks that you take. And you're very good at that. And the diversification is what we did today, which is I was not able to mitigate any of my risks, but I was able to diversify them because I have a large collection of securities I can put into my portfolio whose behavior under negative scenarios is different. And in the context of investing, when the risks that you have are lower than normal, whatever that may means, is the concept which is referred to as arbitrage. And I say this because if you have a mathematical formation, in mathematics, the concept of arbitrage is making money for free. In investments, it's hardly ever used in that context because it is considered to be impossible to make money for free. If you can make money with a risk profile which is less than normal, we'll refer to that as arbitrage. So we could think that what we did here today is an example of arbitrage. I was able to construct an investment that originally had very high risk, 50% standard deviation, reasonable probability of losing $20 million, to another one where the probability of losing money is much, much smaller. I did that not by hedging, I did it by diversification, but the context is somehow similar. We'll refer to these things as arbitrage. And hedge funds, some of you mentioned hedge funds, are the entities which specialize in doing that. And hedge funds today are big machines to obtain things like that. Perhaps I'll give you an entertaining example of a hedge fund, perhaps to stress my point, also because of it's entertaining. When I started my investment in hedge funds career, about more than 20 years ago, there was a very interesting hedge fund who had the ability to, I'll explain, it sounds bad, okay, but I'll explain. They had the ability to front run Korean housewives. They made a lot of money doing that. Okay, what does that, do you understand what that means? Front run Korean housewives. Okay, front run is when, if I know you're going to do something, I do it before you. Then when you do it, you make the, say, you're going to buy stock. Then I buy the stock before you do it. Then when you buy the stock goes up, and then I sell. So I buy because I know you're going to buy. Okay, so in the year 2000 or so, there were no social media, nothing, okay? There was a hedge fund that I knew whose job was to find out which stocks Korean housewives like and buy them before they do. Why? Well, in the Korean culture, a bit like the Japanese, you have these high earning couples where the man works and the wife stays at home. That's the way it is. And they're both very well educated. These ladies, they have a MBA, a PhD, who knows, right? So they have a lot of disposable income and nothing to do. So what do? They talk to each other and they invest. But of course they invest in what everybody talks about amongst themselves. So this hedge fund had a way to tap into those conversations. If I have to imagine, I would say that the wife of the portfolio manager is the one that was in the circle. I don't know. I don't have that information. But that's all they did. So they're talking about this company and they buy the company. So, well, they don't like it anymore, then they sell it. And that's how they made money. Understand? That is front-running Korean housewives. Okay. Imagine how you would do that today. How would you do that today? You don't have to front-run Korean housewives. You can front-run almost anybody, any collective. My favorite example, GameStop, which I will tell you about tomorrow. You know GameStop? The company GameStop? What happened in GameStop?
It goes up, then it falls again.
Exactly. Very good. That's exactly what happened. But now let me select the piece of that which I'm interested in, which is there was a collective who, for whatever the reason, decided they were going to buy a single stock called GameStop, right? 2 million people, they're talking to each other. For whatever the reason, they want to buy GameStop. So what I would do is I would have an agent that reads Reddit in real time. I said, no, now is the time to buy. Because these people are slower than me. I can buy before they do. Right? I said, are you guys sure this? Oh, they're hesitating. I sell now. So have an agent that uses as input data the Reddit posts on Wall Street bets and acts on the basis of that. You can do that today. It's very easy.
Is it legal?
Yes. Yeah, that's legal.
But it's not legal anymore if you engage, or like
What is, okay, so there's a few things which are not legal to do. This thing I'm saying is completely legal. Okay. What is not legal, or sorry, you can be compromised. Depends if they catch you, right? What is in principle illegal is to say, oh, any type of market manipulation. Oh, this company is in fact, terrible finances and this and that. And then you do that to create a market wave. That would be on the borderline. You could have problems with that. Of course, if you have access to material non-public information, MNPI, that's completely illegal. And that's been illegal since 1934, since they created the Exchange Act in the United States, right? But no, this activity I'm talking about, this is legal, yes. So you don't have to find out what Korean housewives want to do now. You can do this with any collective on social media. And this is something that is happening, is doable. And as I don't know who I was talking about this earlier. Was it Patrick? I don't know. I was talking to someone about this because it's one of the big changes that we see in investing today is that if the data consumption that you have, the data input you have, is numbers only, you are at a disadvantage. Your data should contain textual information too. Otherwise, your consumption of data is substandard and you are at a disadvantage. And this is a very good example of that. You can say, no, this company has to, I mean, there was the reason for the short on GameStop was very sound. You can agree or disagree, but it was very sound. He was a company that had no internet business plan, sold everything on the store, no nothing streaming, nothing. So well, in my book, that points to trouble ahead. This company cannot survive the digitization that we're going through. Well, 2 million teenagers decided against you. Guess what? They're right. You're wrong. So the fundamentals don't quite matter, but social trends matter. They always mattered, but now you can detect them. And this is the area which is beginning to change the way we do. I call it social fintech. It's one of my favorite topics, social fintech. Okay, all right. So anyway, that's what I was telling you about. And in it, you can think that what I'm talking about here is a type of information asymmetry. I know more than most people because I am aware of these trends which are being generated. Okay. All right. Now, let me, and this is the last thing I want to do today. And this is something which is, everything that I tell you here is very, perhaps difficult. Maybe some of you would love it. Some of you have approached me with ideas that you want to do, and every idea is welcome. Now I want to do something which is perhaps more manageable and easier to do, and this could be from today, what we discussed today. This is content that you can put into your little essay, which is very high quality. It's a good consideration, and that's the use of leverage and the use of collateral. Okay, so I'm going to, because I assume you're tired. I'm tired too, but you're more tired than I am. So I'm going to explain what I mean here by going back to our snow fund example. You're probably, don't be tired of this fund. It's a very good one. Okay, it's very useful to understand a lot of things. So I want to go back to Simone, and I'm going to discuss with you a way in which we can change our fund in a radical way. Okay, and this is what investors do. So listen to me, and then everything is written here. You can read it later, but listen to me. It is going to be very easy to explain. Remember that Interwest was going to go bankrupt, and then we would not collect the money from the ski resorts? Whose fault was that? Maybe we made a mistake, right? Why are we investing $20 million in the fund? You would argue that the ski resorts should have invested 10, and the city should have invested 10 too. So if they go bankrupt, we take the money, but we never ask them to put any money down. In other words, our trade was not smart. We were very quick to put up collateral, the 20 million, that's collateral, right? And we did not ask for collateral coming from the other side. So I think we should go back and revisit how we set up that fund altogether. I think we set up the fund in the wrong way. Because now, Simone, if you're a tough lawyer, you go there and you say, okay, we're going to sign this swap. And then they say, where's your 20 million? I say, where's your 10? And where's your 10? Right? And then they say, oh no, I'm not going to put my 10. I say, well, then I'm not going to put my 20. And then you start a fist fight. Right? And the result of that can change many, many things. So I have some situation here. So the question is, how much money do we need for the fund? So this is what we discussed today. We have to put up 20 million, and then we need to find the rich investors that give us the money. They're happy, they can make money, right? But this is when we have no trust or no negotiating power. Let's consider other situations. Imagine that Simone is a great negotiator. Said, no, I'm not going to put the 20 million. I'm only going to put a percentage, let's say half. X will be a half in that notation. So I put only half. Okay, my collateral is half. What happens when you put half as collateral? Everything changes. Because now I don't need $2 billion. I can do the same with 1 billion, right? So I go to Kalia and said, only give me 10. I go to Shu Qi and I said, only give me, 0.9, right? I have $1 billion, that's all I need. he's going to be unhappy because now I only have $1 billion, so your salary, your commission is going to be less. The income that I have in my company is less now because I'm only managing $1 billion, so my management fee is only 10 million. It's the opposite to what I discussed earlier, where my fund grows. But what's the performance? My God, it's 14%. My investors are so happy, right? I have a better fund. The performance is 14%. And why? Why did it go from 7 to 14? Because you negotiated better. And that opens up a whole set of situations. That's when I have some trust or negotiating power. Another possibility is that the bank lends me the money. In real situations, we could consider that too. Or the city and the security, so they provide full collateral. Now, that doesn't help us with the performance, but it helps us with the risk profile, because credit risk is now eliminated. And now your decision matrix is very complex. And the decisions as to how to build your fund are certainly not easy as it was before. We have a lot of variables that are under our consideration. And the decision as to what portfolio I build is going to be based on a large number of factors, some of which include business considerations like higher return, others that include increased or decreased management or performance fees, others less risk profile. In fact, if we take credit risk into account, given what happened to Intrawest, my Sharpe ratio was not 2. It's much smaller if I take credit risk into account. But now, if I have the collateral from the counterparties, maybe my risk drops, my return is the same 10%. I don't ask for less collateral, I ask for their collateral. And then my risk profile is back to what it was earlier, which is 7.2% plus the risk-free rate or return. So all of these are investment considerations that I can do with all of the information I have at my disposal, but you can see that the situation is now very complicated. And the decision variables that I'm dealing with are substantial, and my chief investment officer has to make a very delicate decision. And then of course I can invest perhaps with 0. And that will be if I deal with ignorant counterparties and they just don't know what they are doing, which is possible too, in which case we take advantage of them. It's very important in the act of investing to take advantage of the counterparty's ignorance. And this is a
care about where the snow is measured.
well, yeah. So then, well, yes. So this is. See, I mean, I'm finishing now. This is why I like this example, because there's many. It's very polyedric. You can look at it from many different perspectives, and everything there is easy to understand, and it's a good caricature of the decisions that happen in practice. Almost everything in practice, I can go back to I created this example in 2005. I've been doing this for 20 years. It's very useful. It's very useful. It gives us a very nice laboratory setup in which we understand what's going on. If you ask ChatGPT about snow swaps, my courses come up. I invented it. I mean, I did this just because I thought it was great, and now ChatGPT has learned from it. Okay, so anyway, that's why I like it. So also in this course, I encourage you to, as a preamble to the rest of the course, to use this as a way for you to test your own investment ideas, which could be very sophisticated, like for example, the negotiation of collateral, and how that will in fact imply a different risk profile for your fund, for your company, for your employee salaries. We've been through all of that. And that is a very good mock-up for how your startup of the future could look like. Because it's not going to be about snow funds, guaranteed. But it will lead to many of the similar considerations. So that's how you learn. Okay? So I like this first class a lot because it gives us a very practical context in which I know that by now you understand every aspect of everything we have done. I know that you do. And I think you should feel very powerful now, because through this you can see how you can tweak reality to make it work in your favor. And you're also aware how you're taking advantage of the ignorance of others. Very important in the act of investing. Are you with me? You feel powerful now? You feel tired, I know that, but you feel powerful? Like you understand everything. And you understand, by the way, the role of those pricing formulas that you saw way back when. Because they are very important in one important aspect of this, which is when the valuation is done for the portfolio. For the most part, it's my lawyer here, my negotiating lawyer, who gets me the best possible deal. And that's how my investors make money. Is that clear? Yes? Great, okay. So, well, I have some more examples of how you can enhance the risk and this and that, but that's the end of it. Okay, that's the end of today. Thank you. You can rest now. I encourage you to think about how you would do the chapter 1 of this assignment. You're free to do whatever you want. It is no, you can ad lib it too. You can do whatever you want, okay? I just want you to try things out and think that this is an asset you're bringing with you to your next job interview.